We are expecting a clearer message from Warsh.
Show me what you care about. What are we watching?
There's a lot of focus on Kevin Warsh, but it's a committee decision.
Yes, you're the sheriff, but ultimately this is a committee and it requires multiple people to decide on where policy's going.
The toothpaste will come out one way or the other.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, heading into the headline act. Attention turning to the Jackson Hole debut for Fed Chair Kevin Warsh, as some officials are beginning to lose patience with above-target inflation, and the Treasury Secretary, Scott Bessent, is looking to put a floor under the bond market.
It's a long wish list, checklist that people would like to see from Chair Warsh today, from reinforcing his inflation-fighting credentials, navigate a policy board that's increasingly divided, at the same time earn the credibility of those FOMC members and the market, or he could do none of that and deliver a big-picture address about AI and task force.
Let's hope we don't get that, Danny. We don't want that at all. Look, at the moment, some officials appear to be losing patience with above-target inflation for the last 5 years. I imagine some are also losing confidence in leadership too. You're going to have two screens up a little bit later this morning, 10 a.m. when this speech drops. You'll have the Fed Chair Kevin Warsh, and on the other side, unfortunately for him, the 30-year bond yield. And that's going to judge success or failure for this speech. And the less he says, the more suspicious people are becoming that he's not that committed to that 2% target.
And the more people will just fill in the gaps themselves. If he doesn't give any sort of clear framework, if he doesn't put any meat on the skeleton that he offered to the market. Look, there's a lot of people who expect him to come out and do just that, from JPMorgan to Apollo to HSBC, saying that he's going to do and use his chance to contain the long end sell-off. On the other side, you have someone like Adam Posen who says this is going to be a Volcker-like speech. It's going to be 30,000-foot level, and you're not going to get the detail that this market so desperately craves.
Were there mistakes made in the news conference? Yes, there were. Does he think there were? Yes, he does. In the FT, they acknowledge this. I think it's really important to go back over the Financial Times cleanup effort the week after the news conference at the last meeting. And this is the important paragraph. People close to Warsh said he acknowledged that he made mistakes, including failing to reinforce his key message on price stability and sowing confusion over whether his longer-term plans to reform the Fed could affect near-term policy decisions. Does he do a better job of drawing a distinction between the two in this speech? This speech is a major opportunity.
I also think the major opportunity isn't just with markets, but with his colleagues. The Wall Street Journal had reporting earlier this week that his colleagues had not yet gotten any sort of detailed account from the chair himself on how he's reading the U.S. economy. For that reason, it's not just a speech that's for markets, but it's for his colleagues, too, to define how he sees this U.S. economy and how he is as a Fed chair. It is a defining moment, and we will see if he grasps that opportunity.
So bring up the bond board, 2s, 10s and 30s this morning, just about unchanged. 30s yields higher by a single basis point. Your 30-year at 5.20. Your 10-year this morning at 4.68. Coming up this hour, we'll catch up with Peter Tchir of Academy, waiting on Kevin Warsh to come out swinging. Shweta Khajuria of Wolfe Research on Alphabet's brain drain hitting the bottom line, and Claudia Sahm of New Century Advisors as investors watch for guidance out of Jackson Hole. We begin this hour with stocks and bonds holding steady as Fed Chair Kevin Warsh prepares for his first speech in Jackson Hole. Peter Tchir of Academy Securities writing, if I were Warsh, I'd take the gloves off and come out swinging. Hammer home the point that while inflation is bad, the exact level that is bad is difficult to determine. Peter joins us now for more. Pete, good morning.
Morning.
Is that the speech you expect?
I'm not sure I expect it, but I do think markets are maybe dismissing. What I would love to see him do, and I think he should do, it might roil bond markets for a day or two, but I think the best thing would be, one, point out we've got to do a better job of measuring inflation. Why is PCE this gold standard? Look at Truflation. You can pull up Truflation on your Bloomberg terminal, right? Bloomberg's taken the time to describe that. Look at other metrics of inflation. So I'd hammer home, let's look at alternative metrics of inflation, some of which were much higher in 2020 and 2021 and may have made the Fed actually hike sooner. And then the other part of that is I'd really go back and say, on top of that, once we identify inflation, can hikes fix that inflation? Will hiking rates do anything about inflation due to the war? Nope. Will it do anything to slow down the data center AI spend? Nope. So why would we hike if our two sources of inflation aren't responsive? That's what I would love to see. I think markets would freak out briefly, but I think once we all had a, oh, well, that actually makes sense and is logical, we'd be much happier.
You know it makes sense. I know it makes sense. People at home know it makes sense. The problem is bond bears are doing this, listening to you. I can't wait to see how the 30-year if he puts up that speech later on this morning.
Well, then I think we go a little bit wider. Then rationality sets in, and like bond yields are actually relatively high. They've been moving in line with things like diesel. They've certainly been affected by the supply. And two, he might be able to then point out or talk about a potential Fed operation twist, right? To me, that's really the big firepower he has. I highly doubt it comes out of this. Maybe somewhere in the Q&A, if someone asks about the Treasury twist, he can mention, well, we could at the Fed re-implement operation twist. They have about $450 billion of Treasuries maturing within 1 year and $1.2 trillion of Treasuries maturing within the next 3 years. If they start talking about an operation twist, you could do 50 billion, 100 billion a month. That starts moving the long end of the curve.
What's the balance between a Fed Treasury Accord 2.0 and just straight up fiscal dominance?
I think, to me, if you do this Fed twist in conjunction with the Treasury twist, I think it works very well. We aren't growing the balance sheet. It's not technically QE. It does suck a lot of duration out of the market. It would help the hyperscalers and things get lower prices on their bond yields because they're all pricing T plus a spread. So I actually like the idea. And to me, it makes sense to be coordinated, right? If you have an effort of this and you admit it doesn't hurt the country, I don't see any reason not to do this. Having said that, I do think Bessent's, to me, this isn't just bond vigilantes. This really has very little to do with bond vigilantes. It has everything to do with the global supply, this glut of bonds coming out, this long duration supply coming out of the hyperscalers in particular. So you have to address this. And I think so far we've only brought a pistol to this, and we need the bazooka, and only the Fed, I think, can deliver the bazooka.
Steve Myron, formerly of the Fed, had an op-ed out this morning in the FT, basically saying the long end wasn't a problem, that it's due to global growth, the reason that it's higher. And what's more, it'll come down once tariffs get implemented again and oil prices come down too. Do you think that that's a view that this Fed chair also shares, that the long end isn't a problem?
Yeah, I don't think it's a huge problem. So again, but they might be under kind of, if the Treasury views it as a problem, he's got to look at it. I can see taking steps to control it. And again, I wouldn't launch an Operation Twist today. Merely tossing out the possibility could help control it. Again, if we see any sign, so far there is no sign of hyperscalers slowing down, that would come down. I agree with you, right? We're starting to see stories about more oil flowing through Hormuz, right? If there's some sort of, detente, some sort of quote-unquote deal, I don't know whether we'll get what we want out of Iran, but if oil starts coming down, then you can let diesel and gasoline start coming down. Some of the inflation pressure goes away anyways.
Are you making the case to hold rates in September?
Oh, yes. I think we should hold the rates throughout the year. I would love to see the task force come out, and I still think we're going to see a cut before a hike. I was hoping we'd see a cut this year. I doubt it, but I do not think we see a hike this year at all.
What gives you confidence we're sufficiently restrictive? Some members of that committee don't have that confidence.
One, I think it's kind of this wide band, right? I think we're all like, well, what's the neutral rate? I think Yellen was quoted saying, well, the neutral rate could be anywhere from 0% to 5%. So, we're treating this like it's a science. It's not a hard science. It's kind of, okay, where do we think this could be? And again, I think at this stage, we're getting decent growth. We're not having a huge number of jobs, right? The unemployment rate's low. That's functional because of the number of people that have left the workforce, et cetera. I think there's a lot can be done. I would cut rates. Again, I don't think we need to be cutting a lot. 50 to 75 bips take us, 275 to between 275 and 3 on front end. That's what I would look for next year. So it's very different than the market perception. I think everyone's still very focused on this hikes. I keep coming back to just look at something like Trueflation. Look at Zillow real-time rents. Yeah, New York rents are going crazy, but across the country, rents are actually below 2%. So this fixation on the old data makes no sense to me.
So would it be a mistake then, as Torsten Slok suggested he should do, to have this Fed chair give something of a policy speech that is hawkish in order to, again, establish his inflation-fighting credentials?
So I think you should argue that, yes, we are going to fight inflation. We are going to fight inflation very strongly. We hate inflation. Inflation's bad. But let's measure inflation correctly. And that, to me, I guess, is the big disconnect, right? If we look at various measures of inflation, I think, that, again, this data task force, I think...
You know why I'm smiling, Pete, because he doesn't have the luxury of making that speech today.
I know he doesn't.
This is an unforgiving bond market.
Again, how far is it going to go? If you get to, 5% on 10s, everyone's going to be like, you know what, we will buy 10s. So, again, I don't think this is a bodge vigilante thing. I think the supply and demand, I think there are plenty of buyers at 5% on 10s, and honestly, we saw buyers at 480. So I don't think he actually runs that much risk of losing control.
Can you explain where the shorts are coming from, then, on this Treasury market? Because they're elevated. They're not beyond any historical standard, but shorts do exist on the long end of this curve.
So one, I think when you look at the hyperscaler issuance, right? So they're coming out. A lot of hedge funds are long these, right? They look very cheap. I like them. I like owning them outright. But for a lot of hedge funds in particular, you're trying to take a spread bet. So you will be short treasuries against that. So I think when you look at that treasury short, you kind of have to pull out how much of this is people betting against treasuries, or how much of this people is running relative value money who are saying, I like credit spreads, so I'm comfortable taking Meta, Google, Alphabet credit spread risk. I don't want the rate risk, so I've got a hedge on. And that, to me, is a very different trade than being outright short. And I think that's what people are missing. And given the size, scope, and how much has been issued, there is a huge holding of these long-dated spread bonds and the hedge fund community. And I think that explains much more of that.
This market can handle size. It can't handle unpredictability. Lindsay Rosen of Goldman Sachs did a great job of talking about this recently on this programme. The biggest issue is in IG, the financials, it's really predictable supply. When the Treasury comes to market, for the most part, it's really predictable supply. The hyperscalers, Pete, I can wake up any day of the week and I might see a $20 billion offering from some of the biggest companies on the planet. How does that factor in to some of the volatility we're seeing around the world? The fact that the biggest issuers now are very unpredictable issuers at the moment.
So one, I think people are now keeping your powder dry. So if you are at a hedge fund or a long-only asset manager, you want to keep some powder so that you can buy these. They look attractive, they look cheap. As you say, you don't know. You're going to wake up tomorrow, there's a huge deal. On top of that, you see maybe something in the private credit market.
Might be at 5s, might be at 30s. I've got no idea.
That's the other big thing of too, right? When we talk about financials, they tend to issue, their average duration is probably much closer to a 5-year to 10-year sort of maturity, right? They will issue 2s, 3s. You know, the hyperscalers are coming in and they really want to be long dated. I know Besson complained like they should issue shorter date. Why would you fund a long-term growth business with short dated debt? So I think the hyperscalers are all making the right thing, but that's the other big part of this, right? It's the typical, investment grade bond issuers at a much shorter duration. These are coming at much longer. That's why there's so much pressure at this long end of the yield curve. It doesn't have as much to do with bond vigilante. And that's why I think if Wolfe takes a shot at this, yeah, we might get a blip and we move 10, 15 bips wider in a couple days on 10s. I think that would get hoovered up. People would come in and we buy this. But yeah, that's what the corporate credit markets decided. Again, normally we had summers of kind of quiet. I think we're going to be almost $100 billion more issuance this August than the average of the past 3 years. That's a lot to absorb when people are trying to be on vacation on top of it.
We had a record August, a record July, a record June. We're on course for a record year, which would top the record back in 2020. Think about how much debt people had to raise in 2020 because of the pandemic. We're on course to top that. And this month, investment-grade credit spreads are totally unchanged. We've taken down all that supply. Investment-grade credit spreads are totally unchanged.
It's not only that, but their ability to raise money in private markets, too, has been staggering. The price tags behind that, and that doesn't necessarily show up on corporate balance sheets because it's been off-balance sheet financing. So to get a holistic picture of just how much debt out there exists from the hyperscalers and these AI issuers is a difficult task even within itself.
Pete, you're going to stick with us. Peter Tchir of Academy Securities. Futures this morning on the S&P 500, just about unchanged. That speech in Jackson Hole a few hours away. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. Nvidia is pausing revenue-sharing deals with AI cloud providers, according to the Wall Street Journal. The chipmaker stepped back from the program last week. The move for the world's largest company comes amid criticism of circular financing. Anthropic winning a legal battle against the Pentagon. A California judge ruling that the Trump administration unlawfully retaliated against the Claude maker by deeming it a supply chain risk. Anthropic still faces a separate legal fight in a Washington appeals court. The United States is in talks with Venezuelan leaders to take a large stake in the nation's oil fields. Sources telling us here at Bloomberg, negotiators from both countries are discussing the proposal. Venezuela is also considering an exit from OPEC. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, push into control the Strait of Hormuz.
Iran is right now, they're in deep trouble. The Strait of Hormuz is open. We have control and we have the blockade. We're taking a lot of boats. Millions and millions of barrels of oil are coming out of the strait every day.
Up next, we'll catch up with Bloomberg's Paul Wallace, plus more with Peter Tchir of Academy. Live from New York City this morning. Good morning. Surveillance special coming up later on this morning, 9 a.m. Eastern Time. TK, Bramo, McKee leading that coverage of the Jackson Hole Economic Symposium, heading into that speech from the Fed Chair Kevin Warsh later on this morning at 10 a.m. Eastern Time. Once we get through that speech, attention's going to turn very quickly to the economic data the following week. Payrolls the following Friday. The main event a week later, CPI, the final payrolls report, the last CPI report before the Fed meeting in the middle of September. The price action of scores so far this morning looks like this. Equity futures on the S&P 500 just about unchanged. On the Nasdaq, we're down by 1/3%. Major rally for Nvidia in the last 24 hours, underpinning a bounce back for big tech. Elsewhere in the bond market, 2s, 10s and 30s taking their cues from what's going to happen in Jackson Hole and what's happening with crude. We'll get to that in a moment. 30s right now at 520, 10s at 468. Under surveillance this morning, pushing to control the Strait of Hormuz.
Iran is right now, they're in deep trouble. They have very little capacity. It doesn't mean we're finished with the military, but the Strait of Hormuz is open. We have control and we have the blockade. We're taking a lot of boats. Millions and millions of barrels of oil are coming out of the strait every day.
So here's the latest this morning. The president and Tehran both claiming control over the Strait of Hormuz as Iran's foreign minister signals hope for diplomacy, saying progress hinges on the U.S. understanding pressure doesn't work. Bloomberg's Paul Wallace joins us now from Dubai for more. Paul, welcome to the programme. What is the status of diplomacy as things stand? How much movement have you seen on your side?
There's been a little bit in the last 48 hours. Things are still pretty deadlocked, certainly between Iran and the US per se, but we are seeing a little bit of movement between Iran and regional mediators like Qatar and Iran's foreign minister Abbas Araghchi this morning, after talks with Qatari officials in the last day, is talking about how diplomacy is not necessarily dead, and he thinks that the US and Iran can get back to talking. He spoke about the need for a bit of creative diplomacy, but he sounded pretty dovish, certainly the most dovish we've heard Iranian officials this week. There is still a big gap between the countries, and I think one thing is this U.S. blockade of Iranian ports, and that's sort of what Trump was alluding to in those comments that we've just aired. The U.S. is sort of tightening its squeeze on the Iranian economy, and it feels this is very much working, that it's putting big pressure on Iran and Iran's leaders. And I think comments by the foreign minister sort of point in that direction. There's certainly a lot of, the Iranian people and the economy are suffering a lot at the moment from high inflation, from a lack of oil revenues, etc. But it's a big question whether that economic pain is big enough yet to force the likes of the Islamic Revolutionary Guards Corps and the Supreme Leader Mojtaba Khamenei to get back to the negotiating table. Abbas Araghchi is seen as a moderate among the Iranian leaders. His words are important, but doubtless a lot of members of the IRGC and the Supreme Leader have more weight than he does, and their sort of views are more important.
Paul, let's talk about the energy supply as well. I think when you speak to most people on Wall Street, they're brutally agnostic about how energy gets through the Strait of Hormuz. They just want to see the energy get through the strait. How much energy is getting through, and how is it getting through? And what particular shipping lanes, paths are they going through?
So at the moment, I think if we zoom out, we can basically say that, give or take, 75% of pre-war volumes are getting out of the Persian Gulf, from countries like Saudi Arabia, the UAE, Iraq, Qatar. I'm not talking about LNG, but oil. This is crude oil and refined products. So a lot of it is getting to, going by pipeline to Saudi Arabia's western ports on the Red Sea and the UAE's eastern port of Khajuria, sort of bypassing Hormuz. But, probably 6, 7, 8 million barrels a day now is getting out on ship through Hormuz. And this is a big deal. This is something that Trump is keen to emphasize. He's very keen to publicize it and essentially tell the world that, the millions of barrels a day that we've just heard him speaking about are getting through Hormuz. So we're not back to 100% levels, and it's still very dangerous for ships. These are sort of ships that are going through Hormuz in the middle of the night. They're turning off their transponders. They're getting support from the US Navy in case they come under attack, and they are coming under attack. Not all of them, but certainly some of them are being hit, and there's still very frequent hits on these ships. It's unclear whether Iran is holding back some of its firepower or whether it's just unable to cause kind of catastrophic damage, the kind of damage that would stop pretty much all shipping companies from going through. That we just don't know. But certainly it's a risky shuttle run through Hormuz still, but it is happening on a bigger scale. And that's partly why you've seen oil come down as much as it has this week.
Paul, it's good to see you. Appreciate the coverage. Thanks for making time for us this morning. Paul Wallace there out of Dubai this morning. Peter Tchir of Academy still with us around the table. Pete, Kevin Walsh can't declare the end of a war. He can't build a refinery over the next several months. He has to deal with what we've got. How much influence does he have over this situation? None. How much influence does this situation have over this bond market?
A pretty significant amount. Again, it's not just the oil prices, which have been coming down a little bit, but we need to see that flowing through, getting to the refiners. We need to see gasoline prices. I particularly focus on diesel. We need to see diesel come down. We saw a little bit of relief in crack spreads last week. So again, this all makes perfect sense if we can get this oil flowing. You know, we started this new sanctions against Iran. We yet to see anything. You know, I think we were promised that today we might see some, action against a
financial institution.
So curious to see how that plays out. You know, when we talked to some of the one of the generals who worked with us, worked under Trump 1.0, he explained, like, these sanctions are very difficult. You actually need to have a very legally, set up determination who's doing what so that you can prove in a court of law. So there's a limited number of people at the Treasury Department. We assume they've now pulled some additional people in to be able to do that work. So it is going to take time. And I don't disagree with the idea of giving people this kind of, time to, like, oh, you're doing it today, we're going to enforce you, but you can set this right. So I think there will be additional pressure. And at the other side, I think we really want this to end. We want oil flowing. So I think we're probably back to some sort of a pause again.
On the other side of the world, the U.S. continues to play some sort of oil chess, with the most recent reporting saying that Venezuela is considering leaving OPEC, the world's largest proven oil reserves. What would even closer alignment than already exists now between the U.S. and Venezuela mean for this oil market?
I think it would be good, but that's going to take time. I think when we talk to people who've been down there, I think some of the majors are still a little bit reluctant because they have lawsuits from the past. But you are seeing kind of smaller drillers look at this. But it's going to take time to invest. I think, like everything else, there'll be this easy part. OK, we can fix this field. We can turn this back on. Some of that's already going. But to really fix this up, it's going to take, I think, years to make sure that we can refine and process it all domestically is going to take time. So this is all, to me, these are all great solutions. And again, I think we're on the right sort of energy track, but it's going to be a 3 to 5 year sort of plan, not overnight. Again, I think the rest of the globe has to get on board. I look at Canada going through the fight with the U.S. right now. If I'm Canada, I am fast-tracking refining oil. I'm fast-tracking pipelines. Everyone has to get ready for a world where you better have a little bit more at home.
Are you surprised that Canada hasn't made those moves already, especially considering how much things, at least the rhetoric, has escalated between Canada and the U.S.?
I think it's going to take time. I said this, I'm probably going to get myself in trouble again, but I think Canada has to decide you cannot have a green economy and a real economy right now. You either need a real economy with a green economy down the road, and, Canada is much more all in on the green and sustainability. It takes time to shift that. And again, I think you can have that. I'm not saying you throw it out the window, but you have to look at what China did, right? China's built everything up. Now China actually gets more from solar than anyone else on the planet, but that's not how they started. Yeah. They started with coal. So again, I think every nation has to do this, and if Canada's so dependent on sending, tar sands oil to the U.S. where it gets refined, why not put your own refineries? I think it takes time. I think you're seeing signs of that happening. And again, sometimes you need someone to kick the hornet's nest to get this moving. It's just slow in Canada, I think.
Well, someone's kicking the hornet's nest right now. I think it's so sad, the situation we're in, that both sides now, the U.S. and Canada, are politically incentivized. Electoral politics are dictating that this fight gets worse, not better. I think that's really sad.
It is troubling. And again, that so much of it feels like it's come down to political theater, too, in different moves versus policy. And I think that's part of the difficulty in understanding what's going on, is how much is words and how much is action.
It's so stupid. I just don't understand it. We could have had a North American energy powerhouse with conservatives north of the border, conservatives south of the border. And for some reason, the president decided to torpedo the upcoming Canadian election, and Pierre Poilievre isn't even discussed anymore. And you have Carney. It didn't have to be that way.
It didn't have to.
At all.
He's kicking. I mean, it's like, cutting off your nose to spite your face kind of moves that the president is doing at this moment.
Pete, it's good to see you. Thank you, sir.
Thanks again.
When you can explain the Canadian situation, I'm all ears.
I think it's going on globally. Maloney now has to fight with Trump.
Yes.
Everywhere. It's kind of switched to this, abrasive sort of behavior.
Pete, thank you, buddy. Peter Tchir there of Academy. Up next on the programme, Shweta Khajuria of Wolfe Research on fears that Alphabet is losing its AI edge. Alphabet this morning up 1/3% in the pre-market. Equity futures this morning doing okay, no drama, just about unchanged on the S&P 500 on the week so far, heading towards a week of gains higher by about 0.75% on the S&P, following a tech-fueled rally through Thursday, underpinned by a $400 billion plus move in a single session on one single stock. That stock, Nvidia, with a major guide, 70% revenue growth into 28, which is just absolutely ridiculous. In the bond market, 2s, 10s and 30s on the week so far. 2s pretty anchored. Have we opened the door or kept the door open to a rate hike in September with that PCE read earlier this week? 423 on 2s. On 30s, down on the week, down on the month by something like 7 basis points. Up on the session by a single basis point at 520. The morning before the Fed's last meeting, we were trading around 5.1%. Kevin Warsh had a bit of a sloppy news conference over at the Federal Reserve, the Fed chair helping to drive yields higher at the long end. Since then, Treasury Secretary Scott Bessent's been very busy, preventing the Japanese from monetizing dollar assets, giving them the opportunity to avoid doing that, one, and then two, intervening verbally with the prospect of intervening actually with some bond buybacks in the next couple of weeks.
There's this awkward tension happening, and I mentioned this op-ed from Stephen Myron over formerly of the Fed, who basically said the 30-year yield, what it's been doing is completely within reason. Global growth is really good. It'll come in when oil prices come in and tariffs come back. Okay, well, if the 30-year yield isn't a problem, why do you need a Treasury Secretary to step in and do something about it? There's this weird tension to say, no, this isn't a credibility issue with the Fed. We like Kevin Warsh. That's not the problem. But also saying, oh, we have to act. Something is wrong with the 30-year yield.
They seem deeply uncomfortable with where yields were, detached from fundamentals. I think a lot of people in this market believe the fundamentals back up in yields.
They do. And I also think Peter Scheer's point about the tech part of this is really interesting, this idea that you're taking on so much long duration supply from tech players that you want to be hedging it somewhere. And the way to hedge that duration is to short treasuries. I don't really know how Fed credibility is going to fix that problem.
Pete's in dreamland. Can you imagine if we get the speech that Pete's looking for later?
I feel like that's how everyone has their checklist, right? I want to hear this, X, Y, Z. The odds of him doing all of that and being able to do all of that in a coherent manner without upsetting someone is just such a tall order for this.
The spread between what people want and what people might get, it's getting wider and wider. 3 hours away from the opening bell. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. That's the case for PayPal as well, and I'll tell you why. Shares are sinking 14% in the pre-market. Honor reporting that Advent and Stripe are no longer pursuing the company, and it's because the group had offered to buy PayPal for $50 billion, but for PayPal, that was not enough, and this had become a big reason for the stock's recent run. It was up some 40% in the last quarter, but as you can see, with the deal potentially off the table, investors are taking out some of that takeover premium. Meanwhile, let's get to the earnings. Affirm shares rising nearly 13% in the pre-market after strong results from the buy now, pay later firm. And there's an interesting consumer read here too. Spending through Affirm jumped 36% last quarter to $14 billion. So consumers are increasingly using these buy now, pay later services to fund their purchases. But importantly, they say that credit performance remains stable. So it's another sign that the consumer is still holding back, is still holding up, even if they might be increasingly stretched as they use more of these services. And we end on Gap. Those shares are also rising, up 14% in the pre-market. After the results themselves, they were pretty mixed. The company raised its outlook for adjusted earnings, but trimmed its sales forecast, and that was due to struggling sales at Old Navy. And that repeated weakness may be why investors are very happy about a change at the top. They are replacing their Old Navy CEO with someone with experience at Walmart and Target. So they're hoping that can help improve Old Navy, which makes up more than half of Gap's revenue. John.
Yahira, thanks for the update. More from Yahira in the next hour. On our radar this morning, a judge ruling the Trump administration must lift its ban on Anthropic's AI technology for federal agencies. The Pentagon deeming the company a supply chain risk following a dispute over the use of autonomous lethal weapons. Elsewhere, Wall Street pushing for clear communication. In Fed Chair Kevin Warsh's speech at Jackson Hole this morning, investors at JPMorgan, Apollo, Morgan Stanley see today as an opportunity for Warsh to convince the market that managing inflation is his priority. And finally, oil exports recovering in the Persian Gulf. According to Goldman Sachs, flows are now 2/3 of pre-war levels. The team writing shippers and crude producers are adapting with a rise in dark crossings and ship-to-ship transfers.
And that's part of the reason that oil prices have been coming in as late. I have to say, with every sort of global crisis we faced, it's remarkable to look at the adaptability of this world, whether it be tariffs, whether it be COVID, and now the closure of the Strait of Hormuz. The other adaptation that's been made is on the supply, the mix of the type of energy that's being used. China, for one, has a huge stockpile, and two, has really pivoted away into clean energy. And I wonder if that makes it all the more difficult to bring China to the negotiating table, to get them to influence Iran, because at least for now, they have this situation under control.
We're lucky that China stockpiled. We're lucky that Saudi had an east-west pipeline ready to go that they could take advantage of. This story would be very different without those two things. The change in crude is a major factor for the Federal Reserve as well. If you just look at where crude was into this war, February 27, $72. Yields on 30s, 461. We've had a 60 basis point move in yields at the long end, and you've had a 20% plus move in crude too. The two are connected in some way. We priced out cuts, we priced in hikes, not just in America, but around the world.
But it's always the problem with the two being interconnected, that if inflation was a problem because of crude, what are hikes going to do to that? Hikes can't really fix that problem. And so it leads to this awkward position that you put, especially a new Fed chair in, to try to combat the higher yields and the threat of inflation with tools he doesn't really have.
He can't turn up energy production today.
No.
Can't get a refinery online. The rock and a hard place the Fed chair's stuck between, heading into this speech later this morning, again at 10 a.m. Eastern Time. Let's turn to tech. Alphabet shares falling from their May peak, are raising more than $700 billion in market value. Investors fearing the tech giant is falling behind in the AI race. Shweta Khajuria of Wolfe Research maintaining an outperform rating on the stock with a price target of 460, writing the company's scale, AI investment and category leadership position should enable Alphabet to remain highly competitive in the Gen AI race. Shweta joins us now for more. Shweta, welcome to the program. I feel like we had this conversation at the start of 2025, and in the middle of 26 through summer, we're doing it again. Is it any different this time?
Well, good morning. Thanks for having me. I think it is dramatically different from what investors thought in the beginning of 2025. First thing is that there was a huge caution around Google and Alphabet's search prospect back in early 2025. And that was proven wrong when Gemini was released, and the adoption of Gemini in form of downloads and engagement showed that they are capable of keeping this engagement on search and pricing on search. So that was abated. Now we are here where there's Claude and Claude Code and Codex from GPT all gaining a lot of traction on the enterprise side. And so now on the Google Cloud front, not as much on the search front as it relates to Gemini, but on the cloud front, the caution is, well, Gemini 4 needs to be released, which needs to be highly competitive with the rest of the market and rest of the models. Otherwise, that gap will continue to widen. We are giving Google the benefit of the doubt, given what we have seen over the past year and a half, and we are hoping that the Gemini 4 model will be released sooner than later, sometime between November and February.
How important are TPU sales right now, underpinning this story for you looking out the next 12 months?
Incredibly important. We think that that is one of the most underappreciated parts the street's not accounting for. So we are actually 34% above the street for Google Cloud, and about 10% at the company level revenue, and about 6% above the street on EPS. And large part of that, why we're so well above the street, is because we are accounting for TPU sales. The demand for TPU is very high. The environment remains capacity constrained, and TPUs are one of the best price performing chips that are out there, even outside of the Google Cloud environment. For example, the Apollo Broadcom SPV, that's going to hold a lot of TPUs for Anthropic. And so that's going to be a demand engine for Alphabet.
Are you worried, Shweta, though, that there's something of a brain drain going on at Alphabet? They've had some pretty serious high-profile AI leadership exits as of late.
They did. For example, Dean and Shazir and Jumper and Adler. There are a few executives that have recently left Google DeepMind and either joined Anthropic or they're starting their own AI lab. But what we think is that Google can hire top talent from pretty much anywhere that they want, and they actually recently did hire somebody. Second is that they do have a deep bench, and Sergey Brin is now at the helm again for the AI efforts, including DeepMind, and they've brought the operational sort of leadership back to Silicon Valley from London. So part of that will also put fire under the rest of the employees in order to commercialize Gemini rather than not only just commercialize, but also focus on the research side. So they have separated research from commercialization with Sergey Brin sort of leading charge. So it may not be as big of a disruption in the long term. In the near term, probably so, but in the long term, we think that they have a deep bench.
Well, at the same time, Shweta, they want to keep spending. I know you have their capex for next year targeted somewhere around $331 billion. But you've also ruled out this idea that they'll tap equity markets again. Why don't you think that they'll come back to this equity market?
Well, they don't necessarily need to at the very moment. They raised equity already, and that should give them enough room and enough capacity for now. There are two reasons why. So first is they've already raised equity, and the debt market for them still looks fairly attractive. So unless there's a reason to think that the debt market, they're going to get 8% or higher interest, well, there's a low likelihood that they're going to go to the equity markets yet again. The second reason is that for now, if we think that they are going to be doing more and more of these SPVs and JV type structures, well, the CapEx needs are going to start abating because they don't take that CapEx liability. So if we look at where the operating cash flow is and where the CapEx needs could be, they've raised enough amount of debt. The debt markets still look okay to them, and they don't necessarily need to raise equity. Between JVs and SPVs and debt, they should be okay.
Shweta, it's good to see you. Thanks for sharing your thoughts.
Likewise,
Shweta Khajuria there of Wolfe Research. Shweta, thank you. Bullish on the outlook for Alphabet, the timing of that equity capital raise. A monster raise right ahead of the SpaceX IPO.
But they pulled it off. It worked. There's clear demand in this equity market. There's a lot of conversation about how much is that SpaceX IPO going to derail everything for everybody else. That's not what we've seen. IPOs are still plentiful. Small companies feel fine coming to market, and we're about to get another monster, potentially record-breaking IPO in the form of Anthropic.
And then another monster after that.
Correct. Doesn't end. Capital markets wide open.
The supply keeps coming. Nasdaq futures this morning down by about 1/3 of 1%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more of it. Hey, Vonnie.
Good morning, John. Inflation surging in Spain and coming in above expectations in France. Spain's rate rose to more than double the European Central Bank's 2% target. Energy driving inflation in both countries as fighting continues in the Middle East. The FTC is exploring a possible lawsuit against YouTube. Sources telling us here at Bloomberg, the agency has been investigating whether the platform broke consumer protection laws by suspending some user accounts. It's still unclear which accounts are part of the investigation. Citadel Securities posting a record $7.3 billion in second quarter trading revenue. Sources telling us here at Bloomberg that's more than triple the level compared to a year earlier. The firm getting a boost from its push into high-touch equities. And that is your Bloomberg brief. John.
Vonnie, thank you very much. Thanks for the update. More from Vonnie in the next hour in about 30 minutes' time. Up next on the programme, all eyes on the Fed chair.
All eyes are going to be on Warsh on Friday.
He will have to deliver something that is clearer than what he did at the July press conference.
I think it's relatively clear the direction that he's going.
Up next, we'll catch up with Claudia Sahm of New Century Advisors, live from New York City. You're watching Bloomberg TV. There's a hawkish flavour to the guest lineup over in Jackson Hole. Check it out. 9 a.m. Eastern Time, they'll be catching up with the dissenting Beth Hammack of the Cleveland Fed, the former Kansas City Fed President Esther George, which always had a hawkish tilt to the way she voted back in the day, and the way she delivered speeches, more importantly. Catherine Mann as well, on the other side of the Atlantic, joining the team, Bank of England MPC member, also quite a hawkish member of the Bank of England, so look out for that. And then a good friend of this programme over the years, the former Fed Vice Chair, Richard Clowder, joining TK, Bramo, Mike McKee and the team in Jackson Hole. Going into that speech begins at 10 a.m. Eastern Time.
The divide that we've already seen among Fed officials has been notable. Beth Hammack has already been out there speaking, saying that they need to combat inflation, they need to raise rates. Susan Collins also spoke yesterday, though, and said it wasn't clear to her that rates were restrictive. So already you have a divide in the very early speeches or talks you've heard from these Fed officials. So just put that also on the checklist of Kevin Warsh, navigate a divided FOMC.
I'm looking forward to this a little bit later. The price action into it looks like this. Equity futures on the S&P just about unchanged. A very, very mild move lower. On the Nasdaq 100 this morning, we're down by a third. In the bond market, 2s, 10s and 30s. 2s are anchored. 30s have been bid through the week so far. Yields up on the session by just a single basis point, 520 on 30s. Under surveillance this morning, it's all eyes on the Fed chair.
All eyes are going to be on Warsh on Friday.
I think everybody agrees that they want something from Warsh.
He will have to deliver something that is clearer than what he did at the July press conference.
I think he's going to have to use this opportunity to talk more big picture.
You might get some evidence of his reaction function.
I think it's relatively clear the direction that he's going.
So here's the latest this morning. Markets bracing for remarks from Fed Chair Kevin Warsh at Jackson Hole later this morning. Wall Street looking for clarity on plans to bring inflation back to target. Claudia Sahm of New Century Advisors writing, we have a clear sense of what Warsh doesn't like at the Fed, but very little sense of what he's proposing as a replacement. His Jackson Hole speech is an opportunity to bring depth to his vision. Claudia joins us now for more. Claudia, welcome to the programme. How hopeful are you heading into this speech later this morning?
So I am confident that I am going to learn more today about Kevin Warsh as a leader, as a Fed chair. I may not like what I learn, but this is an opportunity for us to really understand his vision for the Fed. We don't know leaders until they have been tested. What came out of the July press conference was a test. I wouldn't call it a really tough one, right? But this is his opportunity to respond, and it will be very meaningful to see how he approaches today and what he shares with us about his vision and how he's going to get us from A to B in terms of better Fed, lower inflation, better policy.
Claudia, it's a big job. You know that. And even the most experienced make mistakes along the way, and we've seen that in various Fed officials and central bank leaders all around the world. What kind of mistakes do you think he made specifically in that news conference that you think maybe this man would look to repair?
Well, I wouldn't want to judge. He is a new Fed chair. He's out of the gate. I think at this point, it's really more about how does he move on from this moment. I don't expect him to backtrack on his kind of big ideas. I don't expect us to get forward guidance. We're not going to get a big lead on September. But I do expect him to show that he's building a consensus. I think responding to some of the feedback, particularly from the committee, I'm sure they had feedback on the July press conference too, and just showing that he's leading a team and he is responding to that as opposed to going it alone. It's a big transition to go from the outside critic to the leader of the institution. I would expect it to be Bobley, but I also expect him to bring it today.
Do you think that he also, Claudia, then needs to address the dissenters, the most dissents since September 2016, the hawkish speech we've had from those and others post-July conference? Is that something that this chair also needs to be addressing?
The chair needs to understand all of the arguments that are on the table. The hawks have been very articulate in what they are seeing in the data, what they are concerned about, why they have dissented. I think that is great. It's really giving voice to the hold, like the majority at the Fed who have up to this point been on hold. It is clear they are looking for more improvement. It's him giving voice to the consensus and also giving us a piece of that debate. I'm not so sure we're going to get that message from Kevin Warsh today. I'm not sure that's where he's going to go with it, but it is going to be in the air at Jackson Hole. They are going to be talking about inflation and the inflation outlook.
Claudia, how much, though, do you expect any sort of framework, maybe not forward guidance, but a laying out of the data he finds important, the things he watches for and would concern him as he's judging what inflation looks like? Do you expect to get more meat on those specific bones?
I would hope we get meat on some bone, right? He has put out a really big regime change. I mean, if you look at the 5 task forces, they touch almost everything the Fed does. That is massive. To go through that, if he pulls off a piece of it, goes into a little more depth, gives us some more details, I think that would be great. But consistently, Kevin Warsh has stayed at 30,000 feet. He's kind of given the big picture. I think that's where he's comfortable. That's probably the best likelihood of what we get today. We'll just have to see. This is a learning process. We're getting to know him. This is the first, not the last Jackson Hole speech. So, let's just see how it goes today.
Claudia, I'd love your opinion as well on where you think we are. We've heard from so many Fed officials in the last several weeks or so, they appear to be debating again once more whether we are sufficiently restrictive or not. This economy is very, very different to the one we saw a number of years ago. Claudia, do you believe we are sufficiently restrictive? And how can you tell?
I think we're shifting to a place where it would be most appropriate for them to start raising rates. I have been in the hold camp up until about this week, and it's not just on the data. I think the inflation data are mildly encouraging. We're seeing some improvement. The headlines are not good, right? Trade war with Canada, Middle East progress completely stalled out, and a lot of demand for the AI build out that's pushing up chip prices. If I look at the outlook a year out, I am not confident we are moving to 2% on a steady clip. I think it's probably time for the Fed to do more. And I think that's where that conversation is at. There's a lot of data still to come before September and more headlines, but there is something shifting in the inflation picture in the U.S. right now.
Claudia, you alluded to it. What shifted more recently? What got your attention? You listed a few things, but what got your attention and made you think this has changed, it's moved?
Well, no, I think it also was that we had multiple headlines, right? Part of the Fed's staying on hold is saying, well, inflation is elevated. I mean, they can read the numbers just like we can, but the forces will abate. The tariff effect is waning. The gas price effect is waning. The AI, this is narrow. It's not. And we're just getting like really hit with a lot of information that's forward looking that makes you think like, am I really confident that those inflationary effects are waning? Like they might not get a lot worse, but if we get stuck, like we're a lot closer to 4% on PC inflation than we are 2%, right? So you need some good news in the headlines in terms of inflation. And at least in the last week or two, we have not been getting the good news headlines.
If parts of the issue are coming from concerns about geopolitics, high prices of memory, Claudia, what would a Fed rate hike do to fix those?
So a Fed rate hike pulls some demand out of the economy. It's true that wouldn't necessarily go at the root causes of, the supply shock in the Middle East or the tariffs. Now, I think with AI demand, you can debate it, right? We have some of the AI build out that is going through capital markets with bond issuance. So like interest rates are relevant and AI is a demand story. That is not purely a supply side shock. But the reality is, to your point, those higher interest rates, they're going to hit people on the margins, small businesses on the margins. That's where the demand comes out. But like that is the tool the Fed has. They can't stop those tariffs. They can't get the peace in the Middle East. But their job is to get inflation down. So they got to do what they can do. I'm not talking about anything aggressive, but I think just moving in that direction of getting a little more restrictive seems to me like it's likely, not a done deal, but I think we're maybe moving in that direction.
Getting closer. Claudia, thank you. Claudia Sahm there of New Century Advisors. Claudia, thank you very much. Going into the speech again at 10 a.m. Eastern Time with Fed Chair Kevin Warsh. To Claudia's point, we get more data. One more payrolls print. We get that next Friday, a week today. A week after that, one more CPI print just before that meeting in mid-September.
But that's why I think it's so important for many in this market that there's some discussion about what data is important to Kevin Warsh, because we're about to get a lot of it. So this market wants to interpret what they should care about. His view has been that the market should be the guide, that the market should be the one to figure out and interpret the data. But the issue for them, they just don't understand which the Fed is actually acting on. And that makes it all the more complicated and volatile, too.
You are not getting an unfiltered message at the long end of the curve with Bessent's boot on top of the 30-year yield.
Yes, and what's more, by bringing the 30-year yield in, it's not doing the work that Kevin Warsh said it was doing.
Precisely.
Helping to restrict the economy. Won't do that if the Treasury's bringing it in.
Up next on the programme, we'll catch up with Priya Misra of JPMorgan Asset Management, Jeannette Lowe of Baird Strategas, the former Philadelphia Fed President Patrick Harker, and Seth Carpenter of Morgan Stanley. The second hour of Bloomberg Surveillance is just around the corner.
The AI wave is so extraordinary and unabated.
AI has been an earnings momentum freight train that just has not stopped.
The competitive pressures are absolutely rising.
The pipeline is on fire.
We're still seeing incredibly voracious demand for compute.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Your price action of scores look like this. Equity futures just about unchanged on the S&P, negative 0.25% on the Nasdaq 100. In the bond market, 2s, 10s, 30s, yields shaping up as follows. Yields at the long end higher by a single basis point, and the long end under the spotlight this morning. 520 on 30s, heading into this later this morning, just a few hours away, 3 hours away. Fed Chair Kevin Warsh speaking in Jackson Hole, Wyoming.
And the market is coming with its long checklist of wishes and desires of what they'll hear from this Fed chair. But of course, there's a difference between what we want and what we might get. Claudia Sahm made a great point. Usually the first speech at Jackson Hole from a Fed chair defines who they are, whether it be Yellen talking about the labor market and that importance for her, Powell and risk management. Who does Kevin Warsh want to be? And does that involve some cleanup of who he was at his July press conference?
This was a really unforgiving bond market for the last several weeks. When you put it all together, we've only had a 10 basis point move at the long end since he started speaking a number of weeks ago, that Wednesday in that news conference. Mistakes were made, and they were acknowledged, I think, in the FT Cleanup Act. Which mistakes are we talking about here? Openly flirting with moving the goalpost on inflation and moving away from PCE. One, there were many, but I'll give you two. And the second, flirting with using the balance sheet instead of the interest rate policy as a primary tool. That's a rookie error too. It's too early to have that conversation. That's where you start to see yields bleed higher at the long end of the curve.
And then there's also a lot of questions caught up in that about what the Treasury is doing too when you think about the balance sheet. So that is a problem. But I guess the question is this just an issue where he needs to clarify some things? Or is an issue that he actually needs to be more aggressive in order to change what the market is pricing? To your point, we've only moved 10 basis points. So a lot of people would look at this and say, why do you need a massive change in policy as it stands? Why do you need all this hawkish speech from various Fed officials that have come out? Because perhaps even though there are questions about his performance, has the economy really changed that much? Has the 30-year even really changed that much?
You've got to acknowledge, Danny, and we all have to, that ending forward guidance comes with a cost. I'm on board with ending forward guidance, but acknowledge the cost. Not done this for a while, but Ed Bradford over on X, fantastic follow on the bond market, at full carry if you want the handle. What he said recently is really important. When you end forward guidance, you introduce volatility. When you introduce volatility, you increase term premium. When you do that, you should expect a higher long end yield. And in many ways, that's what we've seen in the last few weeks.
But one of the things that Chair Warsh didn't do, and perhaps he'll use this as an opportunity to do it, is you can say all well and good that we're going to increase volatility, but does that increase vulnerability? And I think that's what a lot of people are worried about. So what also might be helpful is him to set out terms that this doesn't make us more vulnerable, even if it makes markets more volatile.
These are the kind of news conferences you can do in like 2018, 2019.
Right.
When you don't have all this supply coming from elsewhere. When you've not been above target for 5 years on inflation, it's the wrong moment to have this conversation. Fed Chair Jay Powell, I also believe at the time, former Fed Chair Jay Powell, I believe he was also thinking about whether PCE had the same value as it used to. But he acknowledged that when you've been above target for so long, these aren't conversations you can entertain. And that's the mistake I think you've got to repair. There is a longer-term goal at the Fed, and we can have that debate separately. And then there is the short-term commitment, the longer-term commitment to the inflation target, but the short-term policy discussion to get there. And the lines got blurred. That was acknowledged in the FT piece as well. There's an opportunity today just to clarify the two lanes you want to be in.
But can he do that without betraying his ethos, and that is shaking and changing the Fed? He definitely wants to do that with his various task force. But to your point, if he just comes out and says, here's what we've heard from the task force so far, we're still looking at other measures of inflation. Do we want to use PCE? Maybe we do, maybe we don't. But if he comes out very forcefully and saying, look, here's what we're looking at, laying things out, can he do that at the same time as trying to change the Fed? Because committing to something and then changing it down the line, he'll get the same criticism that he's moved the goalposts.
What's silly about today is he'll be judged by whether 30-year bond yield finishes the session. That's how we'll judge this speech today. And so much of the long end of the curve is out of his control. And I find that a little bit ludicrous, but that's the world we're in right now.
Do you think maybe he should come out and say, hi, big tech, can you please issue in the belly of the curve?
Well, Besson did, and maybe he'll repeat that too.
I'm not sure big tech would listen.
No, I'm not sure they would either. Coming up this hour, we'll catch up with Priya Misra of JPMorgan Asset Management as markets pause ahead of Jackson Hole. We'll speak to the former Philadelphia Fed President Patrick Harker as Wall Street waits on policy signals from Kevin Warsh. And Seth Carpenter of Morgan Stanley believing the Fed chair will continue to say less. We begin this hour with stocks edging lower as investors look look for clues from Jackson Hole. Priya Misra of JPMorgan Asset Management writing, there is a way to massage the reaction function without giving forward guidance. The market doesn't need hand-holding or play the referee, but tell us the rules of the game. Priya joins us now for more. Priya, good morning.
Morning.
We had a clean-up act in the FT article. Do you expect another one later this morning?
Yes, I do, because I think the market has this angst around the reaction function, around Fed credibility. You know, we're debating all these big issues. What data? What's the inflation target? But I think we should not be debating the big question of, is there commitment to price stability? Absolutely. Hopefully we hear that today. Is interest rate your primary tool as the Fed? Absolutely. Don't use the balance sheet. Use the balance sheet when there's an issue. Don't use it for monetary policy. It's very hard to figure out. And then I'm hoping we get, I think, to me, July was not a policy error. It was a communication error. So what I'm really hoping is a sense from Chair Walsh, why did they stay on hold in July? I think, you know, they had a family fight and then they decided to stay on hold. Explain it. The minutes explained it. I think it's not forward guidance, it's backward guidance. If you can just explain, we stayed on hold because the data going into that meeting was just a little bit weaker. The momentum in inflation slowing down. We're dealing with supply shocks. And then that'll help us, I think, react to data next week, because we're going to get a lot of data next week.
The data's on the side of a hold, given the way it's come in since that news conference.
Yes.
In many ways, he set these expectations for himself by saying things like inflation was a choice. It implies ultimately that they've made a choice to be above target for 5 years, which leads to the question, why are you doing nothing about it then? Mike McKee asked the question in the news conference really well. He keeps saying the same thing. Going to do something about it? Hasn't he set these expectations for himself?
You know, I think he's trying to create regime change. He came into the Fed as the new leader, talking about let's have an open mind. And I'm all for that, because the economy is changing. Maybe we should have an open mind on what data do we look at? How do we get it more real time? I think the problem is the credibility is a little bit weaker, and we are dealing with supply shock after supply shock. I think this is the new normal of supply shock. So when the Fed starts to question these big picture issues at the time when credibility is a little bit questionable, I think the market then runs to maybe they're okay with a higher inflation target. We need to hear today very clearly, no higher inflation target, we're committed, and maybe even go as far as to say that's not forward guidance, but if the inflation data turns or we see no improvement in inflation, that the Fed will not hesitate to hike rates. I think if we hear that clear, that's not forward guidance. That's just telling us we're data dependent. I know that's not used anymore, but if you don't have forward guidance, you're data dependent. I know that was a Chair Powell term. But essentially just hearing that, telling us the commitments there, we're not questioning the big issues. We're just debating how we get there.
How much of this speech do you think is necessary, not just for markets, but for his colleagues as well, to build some sort of consensus and trust among them?
That's a good point. He is the new leader of the Fed, and he did come in with, you know, criticisms in the past. I do think the Fed is divided. I mean, you see it in the dot plot, you see it in the Fed speak, for good reason, because we're dealing with a supply shock. Is AI a demand shock or a supply shock? It's probably both in our view. There are people at the Fed who say, let bygones be bygones, let's just look at momentum. There are others who say, no, we've got a real credibility issue. How does he thread that? I mean, the discussions at the Fed have to be really intense right now because we're not getting clear data one way or the other. So is he trying, I think, is he messaging how open he is as a Fed chair? How much is he going to work towards consensus, even as they debate some of the bigger questions? Maybe there may be a little bit of messaging to the Fed, but I think it's much more the market, because I do think the reaction the last month tells you that the market is just nervous about the Fed function and not so much inflation. See, this move has all been real rates, long end led. That's a dangerous move. No wonder Secretary Bessent reacted. I applaud him. As an investor, as a taxpayer, I think it was a good thing. We need Chair Walsh to help.
Can you just get into that more? Because there are a lot of criticisms of what Treasury Secretary Scott Bessent did, that it doesn't address things like hyperscalers, like the fact that yields across the globe are moving, that this wasn't a specific problem for him to address, and it was throwing money, bad money after good, essentially.
So I hear some of the criticisms, right? Do we all want a clear, unfiltered market? It's not just Chair Walsh. We would all love that. But when you have a supply-demand mismatch, which is happening in the Treasury market, I would say it's happening in high-quality fixed income space. There's the hyperscaler, there's US sovereign debt, there's global sovereign debt. For the Treasury as an issuer that's focused on lowering the cost to the taxpayer, to say, let's rectify that balance a little bit, I think it's right. So I think what he did was okay. Is that solving the fiscal situation? Absolutely not. Is that changing hyperscale? I think the hyperscalers will keep issuing long term because these data centers take a long time to issue. So it makes sense from an asset liability standpoint. But it bought, I think, the Treasury some time until Chair Walsh can come and reiterate, hopefully today, that they're committed to price stability. And we see the supply and we see, the markets paying you more to take down the supply. I think there's so much angst about supply in September. I think it's priced into spreads, it's priced into rates. If the supply gets taken down, we're still seeing inflows into bond funds. I think it'll help. We need a long-term bipartisan solution for fiscal, and hopefully that happens at some point post midterms. But I do think you can see my hesitation.
Yeah, you didn't sound confident at all.
But I think what Secretary Besson did was just rectify and scare the shorts. I think those needed a little bit because the long end was becoming a problem for every other asset class and for the interest-sensitive parts of the economy where, this whole debate, what is neutral? There is no one neutral rate. For the hyperscalers, it's probably much higher. For the housing market, it's probably lower than where we are. And they're trying to look at this on an aggregate basis, which is the tricky part.
He scared the shorts. Are the longs coming in? Are you ready to buy at the long end?
We're getting tempted. I do want to hear today from Chair Walsh that, number one, he hurt the bond market. If we just get a payment speech or have a great conference, guys, that's not a great sign. So hopefully we get something from Chair Walsh. We want to see the data next week. But term premium, the fact that this is real rate driven, duration starting to look attractive. We still like it in credit space because you just pick up that additional spread.
So why credit and not sovereigns? That's an interesting distinction.
You just get a little bit more carry cushion, right? If I'm buying the long end, but I'm getting 150 basis points more, it gives me that cushion. If rates do rise, what if the 10-year gets to 5%? By then, I think every other asset class starts to freak out. Then that, it gives me that ability to withstand a little bit higher rates in the long end. So we are starting to think duration makes sense, but you can do it in mortgages, you can do it in credit and just pick that additional cushion.
We're getting closer. Priya, thank you. Priya Misra there of JPMorgan Asset Management. Yields have been higher worldwide. It's a global phenomenon with the exception of one country, China. China's economy is in a different place right now. The PBOC, this headline crossing just moments ago, boosting credit support for China's property sector. If you plot a chart of yields so far year to date, sovereign yields year to date, and just show, Germany, the US, the UK, pick any member of the EU and then compare it to what Chinese yields have done over the last couple of years, different picture.
And it's part of the reason, again, we've seen all this support from the PBOC's attempt to come in, both from the government as well. It's a difficult place that they find themselves in. Again, to your point, completely different from the rest of the globe that is dealing with this problem of deficits. So while China can do things to stimulate the economy, there's a hesitancy to everywhere else because what inflation looks like and already very, very large deficits.
The latest reporting on the Chinese central bank there. Let's give you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Anthropic winning a legal battle against the Pentagon. A California judge ruling that the Trump administration unlawfully retaliated against the cloth maker by deeming it a supply chain risk. Anthropic still faces a separate legal fight in a Washington appeals court. The death toll rising after that flash flood hit a Nepalese valley near the Chinese border this week. Now at least 389 people confirmed dead and more than 1,200 missing. Assessments show a glacier and bedrock collapse triggered the seismic event. Rescue efforts are still underway. Japan spending a record $96.4 billion over the past month to support the yen after falling to a 4-decade low. Finance Ministry data show the government intervened in currency markets from July 30th through August 26th, with US support also backing the effort. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for the update. Up next on the programme, fanning the trade war flames.
The Canadian officials have treated us very badly. People oftentimes, they'll ask me, who's the worst to deal with on trade? And I said, that's easy, Canada.
Up next, Jeannette Lowe of Baird Strategas, live from New York City this morning. Good morning. Stocks unchanged this morning on the S&P 500, negative by 0.25% on the Nasdaq, down by 1/10 on the Russell, pretty much unchanged heading into the headline risk event of the week later this morning in a few hours' time. Kevin Walsh and Jackson Hole. In the bond market, 2s, 10s and 30s into that. Yields pretty stable, anchored around 420 at the front end, 423. Payrolls a week today, CPI 2 weeks today, and then you'll get the big one, the inflation, the interest rate decision in mid-September. 468 right now on 10s, 30s at 520. Under surveillance this morning, let's talk about trade, fanning the trade war flames.
Canada's been ripping us off for a long time on trade. The Canadian officials have treated us very badly. They're nasty people. People oftentimes, they'll ask me, who's the worst to deal with on trade? And I said, that's easy. Canada. They want to be treated like they're a state. And so we just can't do that anymore.
So here's the latest this morning. The president escalating tensions with Canada as Ottawa retaliates, adding 50% tariffs on US-made copper wire and wood charcoal. Bloomberg's Brendan Murray joins us now for more. Brendan, if this question was presented to the president in his first term, without a doubt the answer would have been China. How have we got to the point where the answer is Canada?
Yeah, exactly. I mean, President Trump at the moment wants to keep things with China very stable. And so that's one of the reasons why Canada is in the crosshairs here. Basically, what we've heard over the past week is a lot of finger pointing, and it's more of a war of words than it is a war of economic things like tariffs. But that said, the risk here is that things can escalate beyond the rhetoric and that both countries start targeting more of each other's imports with import taxes. So at the moment, things are fairly stable. There are U.S. tariffs on about $20 billion worth of Canadian goods. That's about 10 days worth of annual goods trade between the two countries. And Canada has its threat still on the table for its own tariffs to take effect on September 8th. So there is still time for the two sides to get together and work this out and postpone the tariffs that they currently are pointing at each other. But the rhetoric still is as heated as it was earlier in the week.
Brendan, do you and the team believe that domestic politics, both in Canada and the US right now, are aligning to make this worse and not better?
Yeah, exactly. We've heard this from Commerce Secretary Lutnick yesterday. He was pointing fingers at Prime Minister Carney, saying this is he's getting tough with the United States because of their own elections in Canada and political situation, and President Trump ahead of the November midterms is trying to look like he's reshoring jobs to the U.S. and particularly those factory jobs that he promised to do in his second term. So absolutely, a lot of this is politics. The economics at the moment the impact isn't great, and a lot of economists have told Bloomberg News that they think that the Canadian economy can weather a short stretch of this. But again, it's the escalation that people are worried about, that these two economies are so interconnected. The supply chains in the auto industry are so integrated that if they were to become a full-blown trade war, then there could be some economic damage. We get Canadian GDP today, so we'll see what the shape of the Canadian economy was in the second quarter. It looks the consensus estimate looks like it was pretty solid. So we'll see if that number comes in on the high side, whether the Canadians want to do some trash talking, comparing their economic activity with the U.S.'s.
Brendan, what joy. I'm sure you're sick of it already. Brendan Murray there, out of London this morning. Brendan, thank you. Jeannette Lowe of Baird Strategas writing, Trump's low approval rating and potential for Republican losses in the midterm elections could be making other world leaders less willing to cave. Jeannette joins us now for more. Jeannette, are electoral political priorities leading to suboptimal economic policies?
Yeah, absolutely. So, I mean, this doesn't necessarily mean that this has to be the way that it is, but you definitely can see that other leaders are seeing Trump pushing for various demands with regards to trade, with regards to Canada, with regards to Iran. But then these other leaders see that the U.S. is in a precarious position, especially for Trump and the Republicans being on the ballot in November. And they're looking like there's definitely a likelihood of Democrats taking over at least the House and potentially also the Senate. So So Carney could be looking to say, okay, maybe after the midterms, I might be able to get a better deal. Iran might be looking to say, okay, I'm going to wait till after the Israeli elections and the U.S. elections to see if they can get a better deal. But that is definitely something that's also, even in the U.S., when the trade talks fell apart, part of that was also just political pressure on Trump, getting calls from the steel and auto and aluminum industries saying, don't do this deal because we're actually supportive of the higher tariffs that have been in place to protect our industries. So there always is going to be this political aspect to these deals, but we're definitely seeing it play out right now.
Jeannette, does that mean we need to wait realistically until the winter before any of this gets resolved?
I don't necessarily know if we have to wait that long. To the point, there could be some short-term economic damage that comes that then pushes everyone back to the table. But you do also start to see some openings here. So yesterday, Canada specifically decided to not put tariffs on seafood, since the U.S. and the Canadian industries are quite intertwined. They also said that if the U.S. stops making demands with regards to French language, then that could be something that could reopen talks. The Canadian retaliatory tariffs don't go into effect until September 8th. Trump's higher tariffs on autos and steel from Canada don't go in until January. So you can definitely see that there is an opening for talks to potentially get back on track. Sometimes you do have to walk away before you can get a deal later, but we also could be looking to go into maybe October or even November before we see some resolution here. That is definitely a risk.
Jeannette, there also had been this narrative for this bond market that tariffs were actually helpful, that the money brought in helped to lower the deficit, and the Supreme Court decision undid a lot of that work. It's clear this administration cares about the bond market, considering what Treasury Secretary Scott Bessent announced with buybacks. Do you think that's also putting the pressure on this president at the moment to increase his rate of tariffs on Canada and elsewhere?
I think that the U.S. and Canada both wanted a deal, and I think they both thought that they had a deal. Obviously, Trump put these tariffs forth last month to try to get Canada to make some more concessions with regard to the negotiations over USMCA. I think both sides thought that they were getting there, that thought there was going to be a deal before last Saturday, but it obviously fell apart for various reasons. I do think that the administration is concerned about the fact that the tariffs were actually bringing a sizable amount of revenue into the U.S. Treasury. That is actually not occurring at the moment. You've had at least $110 billion worth of tariffs from the IEEPA tariffs now refunded. The administration has estimated that could go up to about $160 billion. And at the same time, so right now you're seeing basically a net tariff cut because we're seeing the offset of the refunds versus the tariffs coming in. I think Trump is kind of waiting for these refunds to get done. He would definitely like his tariff regime to put back into place. So that kind of means rebuilding the IEEPA tariff structure. So that's putting on the tariffs of 10 to 12.5% for forced labor. We do think there's going to be another announcement within the next month related to the investigation for excess manufacturing capacity. So that could basically bring other countries' tariff levels up to what they had under IEEPA. But we really don't think he's going to go significantly higher than that. Once these tariff refunds do roll off, you will start to see more tariff refunds and tariff revenue coming into Treasury. So that will put reduce some pressure on the deficit, but ultimately we don't think he's going to go significantly high. I think the Canadian tariffs are more about politics and the deal falling apart for other reasons than specifically about getting tariff revenue.
Jeannette, it's good to see you. Thank you. Jeannette Lowe there of Strategas. Heading into the midterms, the conclusion that Canada is coming to is ultimately it's better to wait. There is a summit, a Trump-Xi summit on September 24th. What's China's approach going to be to this heading into the midterms?
And of course, they're going to be acutely aware of some sort of announcement of a financial institution that might face some pressure from this Treasury. He, of course, didn't name China, but it felt implicit.
Do you think we go quietly into the weekend with no announcement? I'm still waiting for that.
It seems at this pace that we will. I mean, there's no signs of it.
Watch this space. We were told that by the end of the week, you would get a financial institution that would be sanctioned over Iran. Coming up, we'll catch up with the former Philadelphia Fed President Patrick Harker with Kevin Walsh in the Jackson Hole Spotlight. One of the three dissenting voices at the Fed's last meeting, Beth Hammock of the Cleveland Fed, catching up with the team over in Jackson Hole, Wyoming later on this morning. That special programming, a Bloomberg Surveillance special, kicking off at 9 a.m. Eastern Time. She's been pretty punchy out on LinkedIn. Some interesting posts from her about why she believes this Fed needs to hike interest rates.
And she is not held back. I mean, she was also talking yesterday, speaking about why she thinks the Fed needs to raise interest rates. She has not been quiet, and you've noticed a noticeable pickup in how much she's been talking since Chair Wolfe has taken the helm.
There were 2 points that jumped out to me from her recent policy statement. One was that she's speaking to people in her district that are seeing higher input costs. But 2, and this one was more curious to me, the prices were getting so high that some people couldn't afford to pay them. Is that an argument to hike interest rates? I don't know about that, and I wonder what that debate, that conversation looks like on the programme later this morning.
You mean like that basic economics 101 theory that that's the cure for high inflation,
right?
is
if the
high
price
prices?
tolerance
Yes.
isn't there, what is there to worry about?
Yeah, exactly. And I mean, listen, you have other Fed officials like Susan Collins speaking yesterday saying it's not clear that rates are restrictive. I think the problem is that for some it's restrictive and for others it is not. And I don't know how much of an acknowledgement Beth Hammack has kind of given that other side of the coin.
That's the debate heading into the September policy meeting. Heading into that and heading into this, Kevin Walsh, 10 a.m. Eastern Time, the chairman addressing Jackson Hole, Wyoming, and really addressing global markets. And for some of you, I know, for many of you, addressing the long end of the yield curve. The market right now, your scores, equity futures just about unchanged on the S&P 500. 2s, 10s and 30s in the bond market, yields just about unchanged as well, pushing higher by about a basis point. 520 on 30s. We've said it a number of times already this morning. It's kind of ridiculous, but it's just the way it is. He's going to be judged by whatever happens with that 30-year yield going into the weekend. Success or fail.
And the irony is the long-term trend to the 30-year yield has nothing to do with inflation. Inflation swaps,
no,
unmoved. It's been issuance both from tech and from this government, and yet the volatility will come down to the words out of this man's mouth, even though he has no impact on how much tech is going to be issuing.
Risk appetite is buoyant. People are buying risk assets. There's a reason for high yields.
Global growth looks really good.
Nominal GDP is 6%, 5-6% in this country. That's a reason for high yields. If you really want to factor in the deficit, you can if you really want to. 6%. Budget deficits, persistent, consistent budget deficits in this country, there are reasons for high yields.
You know, I think that Chair Wolfe would argue the same, and that high 30-year yields, if anything, are useful. That's what he said in the last press conference. And then the awkward thing is that the Treasury Secretary maybe doesn't feel the same way and feels that it's a market he needs to rein in.
520 on 30s this morning, 2 hours away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing Marvell shares falling nearly 8% in the pre-market, even after solid results from the chip makers. So what was the issue? Well, investors were disappointed about how little it had to say about its new partnership with Google to make its custom chips. Essentially, they were hoping that they would see growth sooner from this partnership. But now they're going to have to wait until 2029. Plus, the bar was already incredibly high for this name. Shares have run up some 180% year to date. Plus, Nvidia raised the bar even higher when it reported this week. Meanwhile, turning to software, we are seeing Autodesk shares also falling. They're down 4% after the company gave a weaker than expected earnings outlook for this quarter. The bar was already high for this name as well. Autodesk had already recovered sharply from the SaaSpocalypse scare from earlier this year. Plus, it got another boost yesterday alongside the rest of the software sector due to those strong results from Salesforce. So it looks like software not in the clear just yet. And we end on PayPal, those shares sinking on some big news, now down nearly 17% in the pre-market. Honor reporting that Advent and Stripe are no longer pursuing the company. And the problem apparently was that the group had offered to pay some $50 billion for PayPal, but for PayPal, that was not enough. And this had been a big reason why we'd seen the stock surge up 40% just this quarter. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, Wall Street setting a high bar for Fed Chair Kevin Walsh's first speech from Jackson Hole. Investors looking for insight on the fight against inflation in order to ease concerns for the long end of the Treasury market. Elsewhere, the U.S. negotiating with Venezuela to take a large stake in the country's oil fields. People familiar with the matter telling us here at Bloomberg one offer involves signing a 100-year lease. Venezuela is also reportedly considering an exit from OPEC. And finally, Citadel posting a record $7.3 billion trading haul for the second quarter, more than triple the same period last year. Sources telling us here at Bloomberg net income also climbed 250% over at Ken Griffin's shop.
Huge numbers, and we had big results from Wall Street, so I guess that kind of translated this. But when I read the story, I thought, what must the third quarter look like? Part of the reason this was so good is because they've started to route more of their business to what's called the high-touch areas. That includes hedge funds. Can you imagine what hedge fund trading has been like around situational awareness? So you have this scenario where Citadel Securities does really good because of that volatility, and then Citadel, the hedge fund, also does very well because of the moves Ken Griffin made around situational awareness.
I'm still laughing about the moves around situational awareness. So you help them, ultimately you help bail them out, using that term loosely.
Sure.
You take a big part of their portfolio, and then everyone says, clearing event, let's load up again, and he uses the bounce to sell back into it.
But also the remarkable thing is first of all, quite brilliant, and clearly it paid off. But the sources I've been talking to have said that there's still a lot of demand for not only situational awareness, but funds like that. So I don't think this is going anywhere.
They're reloading and leveraging up again.
That appears to be the case, that people still want to give them money even after the turmoil. I'm not clear where Ken Griffin stands in all of that. Clearly he sold, but there's still demand.
Phenomenal work over at Citadel. Record trading revenue over at Ken Griffin's firm. Let's turn back to our top story. Fed Chair Kevin Warsh gearing up to speak from Jackson Hole at 10 a.m. Eastern Time. The former Philadelphia Fed President Patrick Harker writing, Warsh has three elephants in that room: inflation, the Treasury market, and the fiscal situation underneath both. Watch what he addresses rather than what he promises. Patrick joins us now for more. Patrick, welcome to the programme, sir. Always good to hear from you. Out of those elephants, what does he have the most influence over?
Yeah, good question. So he clearly doesn't have influence over the long end of the yield curve. That's never been the case, right? He does have influence over inflation and the credibility of the Fed in terms of inflation fighting. It's not enough just to say we're going to be tough on inflation. You actually have to do something. Now, I think I was listening to your comments earlier, raising the short end, by 25, 50 basis points, is it going to make a huge difference? No, but it's signaling what the Fed means when it says it's tough on inflation.
Patrick, do you think there are questions being asked of this Fed chair that weren't being asked of the former Fed chair? Is there something about the switch here that has raised questions about credibility that little bit more because of the pressure this institution's come under over the past 18 months?
No, I don't think so. I don't think that's the issue. I think the issue is the circumstances we have, right? Right now, we have inflation. We're going on to 6 years here soon of inflation above target. The Fed has to show that it's serious about getting that under control, getting to 2%. And the idea that we change the target, change the goalpost right now in the middle of this fight, that's just, you have to take that off the table. It makes no sense.
Patrick, there is this argument, though, that when Chair Warsh speaks, that he doesn't really need to do any cleaning up, that the long end yields on 30-year yields, they haven't moved that much, as John pointed out, only 10 basis points, that his whole aim is not to hold the market's hand. Do you think that there is an element of cleanup that he needs to do from his July press conference?
Yeah, I think he actually has to take action. As people say, words are cheap. He actually has to show, and this is what you're seeing with the other committee members right now, those who dissented and all the others who are out talking right now. I mean, Susan Collins, my old colleague, she's pretty much a centrist. And the fact that she is now saying we're probably not restrictive is a real tell.
What does taking action look like?
Well, I think they just have to raise the Fed funds rate. Again, it's not going to affect the long end. I get that. But I think it's an important signal to the market.
Patrick, what has changed? You mentioned that things have changed. Certainly the bond market's way more unforgiving now than it was in years gone by. What's changed about the economy that's led to less confidence about ultimately achieving this target anytime soon?
Well, some of it is the build out of AI, right? It's a great sucking sound. It's sucking all kinds of capital in, all kinds of goods, transformers, you name it. So that is different in that you're just seeing this incredible build out in a very rapid time period. So that's one. The second is the war. I mean, let's face it. We talk about supply shocks, and if you read the textbook, you're supposed to look through supply shocks if you're a monetary policymaker. But these supply shocks keep coming at us. They're off, on, tariffs on, tariffs off. It's hard to keep looking through those. They're not so much random acts of God. These are deliberate actions by nation states or within our own administration So those are not shocks in the traditional sense. And they are very different than what we've experienced in the past.
Just on the first point, the AI build-out, one debate we've had on this program, we'd love your input on how rate-sensitive that build-out might be, how rate-sensitive that build-out might not be. Where would you come down on that?
Well, it hasn't to date, right? I think what we're seeing right now is it really doesn't matter. I mean, they're rushing to build out this infrastructure. But what we know through history is, that it's going to take time to actually see the productivity on the other side. We're going back to the 1980s, baby, bell bottoms, disco, and the word re-engineering. Remember this word? That we have to redesign our production processes, our service delivery processes, to take advantage of new technologies. That doesn't happen overnight. So, I mean, that's what we're seeing right now, this rush to build this out. But we're not going to see the payoff for quite a while. It's going to take time to move into the economy.
Well, and that's part of the difficulty, especially if they haven't been rate sensitive to date, Patrick, of what raising rates would actually do to these hyperscalers, especially when the new central bank for them in town seems to be Nvidia, that's happy to finance everything from the entire ecosystem. So if you raise rates, what would eventually then be the transmission mechanism to the AI hyperscalers, if that is part of what's changed and part of the issue for this economy?
I don't think that the hyperscalers will be affected by a rate increase. What they're going to be affected by is people who start to question, where's the beef, right? Where's another phrase from the 1980s, right? Where's the money? And so investors may get a little skittish at some point.
Patrick, it's always good to see you, sir. We miss you. The former Philadelphia Fed President, Patrick Harker, there, weighing in on the situation with monetary policy, just inching towards some action, maybe as soon as September.
Certainly other members of this FOMC would agree with him, and we definitely know that 3 would, considering that they dissented. But it's such a divide right now, and that's part of the problem. And do we get any sort of endorsement of any view from this Fed chair? I think not. The market isn't positioned for that. It doesn't believe that this will happen. It would be interesting if we did, but again, that kind of betrays his whole idea of not giving forward guidance.
I know Patrick disagreed, and I have great respect for Patrick, having interviewed him over the years when he was at the Fed. I'll keep asking a question, though. I do get the sense personally we're asking questions of this leader of this institution that weren't being asked of the Fed chair, who was only running the institution a number of months ago and missed his target for 5 years.
Right. Why is the 5 years? Why is that the delineation? That
all of a sudden now, we're losing patience.
Yes, that all of a sudden now it's a problem, and that this Fed chair has a lot to speak for. The man's new. Again, you can make the arguments of he made issues in his speech, in his presser in July, but can you really argue that holding was a mistake? That something has fundamentally changed with this market between now and July? That argument is much harder to make.
The president hasn't helped the situation. I don't think the Fed chair has helped himself, but there's clearly been a turn since he took over, and a call for higher rates continues into September. Let's give you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Nvidia is pausing revenue-sharing deals with AI cloud providers. According to Wall Street Journal, the chip maker stepped back from the program last week. The move for the world's largest company comes amid criticism of circular financing. A federal judge in Boston has temporarily blocked key parts of new U.S. Postal Service restrictions on mail-in ballots. The 14-day order pauses rules tied to President Donald Trump's push for more federal control over voting. A September 3rd hearing is set to decide whether to extend the block through Election Day. President Donald Trump signing an order to rename Lake Ontario Lake America. The change coming after trade negotiations with Canada collapsed. The Interior Department now has 30 days to update the name in federal databases and materials. And that is your Bloomberg brief. John.
Vonnie, thank you very much. More from Vonnie in the next hour in about 30 minutes' time. Up next, the Fed chair taking centre stage.
I am confident that I am going to learn more today about Kevin Warsh as a leader, as a Fed chair. I may not like what I learn, but this is an opportunity for us to really understand his vision for the Fed.
Up next, Seth Carpenter of Morgan Stanley. Equity futures this morning on the S&P 500 just about unchanged. On the Nasdaq, we're down 1/3 of 1% in the bond market, 2s, 10s and 30s. No drama here either. Heading into the big event later on this morning. Yields higher by a single basis point on 10s, up about 2 on 30s. Under surveillance this morning, the Fed chair taking centre stage.
I am confident that I am going to learn more today about Kevin Warsh as a leader, as a Fed chair. I may not like what I learn, but this is an opportunity for us to really understand his vision for the Fed. What came out of the July press conference was a test. I wouldn't call it a really tough one, right? But this is his opportunity to respond.
So here's the latest this morning. Counting you down to remarks from the Fed chair Kevin Warsh at Jackson Hole in just about 2 hours' time. Investors seeking clarity on his view of the economy and so-called reaction function. Seth Carpenter of Morgan Stanley writing, he is sincere in his desire to communicate less, and we don't expect him to provide anything that would clarify his thinking on the near-term outlook. Seth joins us now for more. Seth, are you saying take an early lunch, get out of the office, head to the beach?
Well, that's the hardest part is, as much as I would love to do all of those things, I think we still have to listen. And while I don't really think he's going to break new ground, especially about the near-term decisions, maybe he does, but he's been pretty clear that he doesn't want to do that. There are things I would love to hear from him. And as he likes to say, there are these big questions, these fundamental questions, getting back to first principles, as he loves to say. And so he said, and you've heard this, a dozen times now, inflation's a choice. Well, how does the central bank choose inflation? In July, he alluded to it in previous commentary in public before he was chair. He was very explicit. The Fed's got 2 tools. The balance sheet, he has said, is clearly much larger than it was before. He has said that's part of why, if not all of why, inflation is running above target. Is all of this focus on will they raise rates, will they not raise rates? Is that beside the point in his mind? Is it really about the size of the balance sheet? I mean, these are the sorts of big picture, not what are they going to do at the next meeting, but more how does he think about the economy? That's what I would love to hear from him.
Didn't that line, inflation as a choice, take on a different meaning when he started to flirt with moving away from PCE?
I mean, I think in that regard, that was tricky. Lots of market debate back and forth. I think he has reaffirmed that, for now, the Fed has a target. They have the annual strategy document, and that he's sort of on board with where things are. But I do think he'll have to be very careful with how he talks about that, because there's a lot of speculation. Is the Fed just going to sort of bundle that up, throw it in the bin, and have an entirely different view on inflation? And I think that would be disruptive.
Seth, is there a risk, if we get a 30,000-foot view from Chair Warsh today, that instead of 10 a.m. today being the most important event is 8:30 a.m. on Thursday when we hear from Governor Waller?
Well, I don't know if I want to pick one specific other time. On the other hand, I do think nature abhors a vacuum. And the less that we hear from the chair, I do think the market, at the very least, will be looking for some guidance somewhere. We'll be looking for some information somewhere. And the less that Chair Warsh says, the more the market's going to pay attention to every other Fed official who speaks. And I think that is a tricky part of it. There's been an evolution, obviously, of Fed communication. When Ben Bernanke was chair, he was very open to everyone speaking, sort of let 1,000 flowers bloom, for lack of a better phrase. And that wasn't the case before with Greenspan and with Volcker, where there was a little bit less chatter from the committee. And so I think it remains to be seen how this Fed will evolve, how much Chair Warsh wants to take control of the narrative. But to take control of the narrative, I do think he has to be more communicative.
Do you think, though, you're getting a clear signal from the committee, who has already been very willing to come out and speak quite forcefully on where they think interest rates should go?
I think we're getting something of a clear signal from each member. It has always been the case that not every FOMC member talks the same amount. And at times there have been a bias. Sometimes there are people who are agitated in one particular direction where maybe the committee is not going and they've got an incentive to speak more. And then other times it's sort of the bias is swung in the other direction. And so I think for the market, it's very easy to just react to what you hear. And when I talk to our clients, I try to tell them, that's great. Think about what this person said relative to how they normally speak. And don't forget, there are lots of other members who are not speaking, but they're still going to have a vote.
The timing of that speech from Governor Waller and that moderated conversation is interesting. It's right before payrolls. And last time we went into CPI, I think, he set the bar for what you'd look for and whether that would lead to him voting to hike interest rates or not. And I wonder if we get the same steer from here. You've got a Fed chair saying no more forward guidance, and then you've got Governor Waller providing it right before payrolls and CPI the week later.
I also wonder how much of his speech he's giving himself options depending on what he hears today, too. If he feels the need that he needs to come in and fill in more gaps, if we don't get that clarification from
Some people have said it. Maybe we've got a shadow Fed chair. I think you were alluding to it. Danny said it about this speech, and I think it's important. If we get the speech that you're anticipating, that's not the kind of thing, if you're on a trading desk right now, that you can go to the beach, because that might be quite a market event. How are you thinking about the two things?
Well, I think this is where it's really tricky, not just because people are hoping maybe to get some very concrete guidance where, best case, but most likely
saying nothing is signaling something.
I think that's right. And so traders are going to have to trade. There's already some probability priced in for a hike in September already, but it's only, in the 1 in 3 chance. That leaves a lot of room for people to shift their views back and forth, and how much of that pricing is predicated on people expecting that they were going to get confirmation one way or the other. That could easily unwind.
The interesting thing, though, is last time after we heard from this Fed chair, inflation expectations didn't move much. Swap markets didn't move much. So do you think that the market reaction is more that, based on what we're going to expect from Fed policy, or is it a credibility issue? Is that anywhere starting to seep into markets?
Well, I guess there's a lot of discussion about credibility, but it's always really hard to see exactly where it shows up in the data. We've seen a lot of movement in the long end of the curve recently, but we've also seen a lot of that movement happening when oil prices move. We've seen that happening when the data prints come out. And so I'm not convinced that the majority of what we've seen so far this year in terms of the movement at the long end of the curve is a clean read on Fed credibility. A lot of the sell-off in rates has come in real yields, right? And so that could be perfectly consistent with this idea that AI is going to drive up productivity, going to drive up growth. The faster the economy is growing, the higher should be interest rates, real interest rates.
Seth, it's good to see you. It always is. Came in talking about cycling. I just wanted to talk to you about cycling as the show started and came back on air.
You should be watching the Vuelta. It's been fantastic.
It's been great.
It's been good.
We were reflecting on Marco Pantani. Wasn't he amazing?
He was quite a
back in the 90s, he was just... It was
larger
just,
than life personality.
Him going up a hill was just like nothing to him.
Yeah.
It was like us going downhill.
And he's one of the riders that watching him win was only slightly more exciting than watching him lose. They were both sort of these really captivating events.
It's a sad story in the end. Very
Absolutely.
sad. Seth, it's good to see you. Thank you, buddy. Seth Carpenter there of Morgan Stanley. If you don't know what we're talking about, watch a documentary. It's fantastic. On Marco Pantani and his rivalry with Lance Armstrong.
Yeah, I think that's a message for me, because...
Yeah, and everybody else. I'm sure
I don't know what you're talking about.
90% of the audience that aren't into cycling. Anyway, Danny, you're absolutely right. If we get the Seth Carpenter speech, you're sending a message to this market, and it might not be well received.
Yeah, I mean, I've had messages come into my inbox saying, this is going to be a snoozer. But again, I think a snoozer speech-wise is not a snoozer for this market, because people are waiting from him, are expecting something, and if they don't get that, they're going to make a vote on how markets should react.
Well said. Futures this morning just about unchanged. Up next, we'll catch up with Subadra Rajappa of SocGen, Jean Munster of Deepwater Asset Management, Mark Cabana of Bank of America, Matt Hordern of Raymond James. The third hour of Bloomberg Surveillance, up next.
We are expecting a clearer message from Warsh.
Show me what you care about. What are we watching?
There's a lot of focus on Kevin Warsh, but it's a committee decision.
Yes, you're the sheriff, but ultimately this is a committee, and it requires multiple people to decide on where policy's going.
The toothpaste will come out one way or the other.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores, the price action looks like this. Equity futures on the S&P, treading water, going nowhere on the S&P 500. We're down by a third on the Nasdaq. In the bond market, yields bleeding higher at the long end once again, only by a basis point or two. Up 2 on 30s to 521, up 1 on 10s to 469. 2 hours away from this right here. Fed Chair Kevin Warsh addressing Jackson Hole, Wyoming, and the annual Fed get-together That is just a few hours away.
And the backdrop is a market that is starved for details and wants to know how he's thinking and what his framework is and what we might see for policy to come. But we know that this is a chair who would probably rather give a 30,000-foot view. I go back to July when he said he himself hadn't made a decision whether his Jackson Hole speech would be big picture or whether it would be something that would talk about what happens between September and December. I wonder, though, again, he made that comment during the presser, if he saw the reaction from the press conference and maybe he started to lean towards the latter.
There was a clean-up act in the Financial Times. We've talked about that repeatedly. I actually shared this quote from the FT earlier this morning, and I think it's worth pointing out once again. In the week after that news conference, people close to Walsh said he acknowledged that he had made mistakes, including failing to reinforce his key messages on price stability and sowing confusion over whether his longer-term plans to reform the Fed could affect near-term policy decisions. That last line's really important because this speech is a massive opportunity to draw a really big line between one and the other.
And he also could do something along the lines of, look, we have these task force working. They're trying to determine what makes the most sense. And here are our early findings, and those early findings are going to be guiding us for the rest of the year. It's certainly something that he could do to lay out some sort of framework, but there is this expectation among some that we won't get that he really does have this mission not to hold the market's hand. And so whatever reaction they might have, he wants that. He wants any sort of unfiltered reaction from this market.
Just have a speech a little bit later on Bloomberg TV, the chairman on the one side, and then just an intraday chart of the 30-year bond yield on the other, tick for tick. Just watching to see how this market receives that address. Coming up this hour, a big 60 minutes. Subadra Rajappa of SocGen as Wall Street waits for Fed Chair Kevin Walsh. Munster of Deepwater Asset Management as Nvidia adds $442 billion in value in a single day. And Mark Cabana of Bank of America heading into the key risk event of the week. We begin this hour with stocks looking for direction ahead of Fed Chair Kevin Walsh's high-stakes speech. Bramo is on the ground. She joins us from Jackson Hole now for more. Lisa, you've had 24 hours to speak to various people in the room. Walk us through what you're expecting in a few hours' time.
What's fascinating to me is how little anyone here has a sense of exactly what Fed Chairman Kevin Walsh is going to say. Ultimately, people are split on what he will say and, frankly, on what he should say with respect to market reactions. Some people are saying he has to come out, like you were saying, give some sense of the fact that he is going to combat inflation, particularly with interest rates, potentially driving down those 30-year bond yields that we'll be watching tick for tick. Other people say the more clarity he gives, the more questions will be asked, and it will actually move him further away from his goal. Ultimately, nobody knows how long the speech will be. Nobody knows exactly what will be in it. What I do know is that people here are incredibly divided. There are people who think that ultimately it will take more information showing that inflation is coming down in order for them to keep rates on hold. Other people, an increasing number of them, saying, actually, it's looking like we have been far beyond our goal for far too long, and it's time for us to become less accommodative. So either way, there is clearly a hawkish tone among the committee. Whether that will be reflected by Fed Chairman Kevin Walsh, unclear.
Bramo, looking forward to the programme. Excited for it. Lisa, guiding you through the big event on the ground in Jackson Hole, Wyoming. That event kicks off at 9 a.m. Eastern Time. For us here at Bloomberg, a Bloomberg Surveillance special with some select guests. The notable one there really is Beth Hammack, the dissenting voice of the Cleveland Fed, dissenting alongside two others at the last policy meeting. Back in 2022, that Payne speech lasted 8 minutes. It went so quickly back in August 22. I was on the ground at the time. I was walking away to get refreshments and then had to run back to the studio, to the set, to get going again. I don't know how many people are expecting an 8-minute direct speech from this Fed chair later this morning.
I can't imagine they are, because, again, I think they're expecting some sort of like big picture view, how he sees the world. But again, just given what Lisa was laying out, that expectations are diverging so much, someone is bound to be disappointed by what he gets. Even a snoozer of a speech, as we've been discussing, says something in itself.
How many conversations have we had over the last few weeks that sound something like this? This is what I want. It's like somewhere over here, but this is what I expect.
Right.
And it's somewhere over here.
Oh, so many of those. And by the way, what people want, it seems like it's an increasingly long checklist of like, clean up what you did from July. Tell me what sort of gauge of inflation you care about. And by the way, tell me if you're building consensus. There's so many things that people want from this Fed chair. And I would just love to get a view into his mind and how he's thinking about it and whether he's listening to any of the noise, be it the markets or the commentary.
You might find out at 10 a.m. Eastern Time when we get that speech. Here's the view from Wall Street this morning. Subadra Rajappa of SocGen writing, the key question is whether Jackson Hole, together with August employment and inflation data, will underscore a greater urgency for policy action. Subadra joins us now for more. Subadra, good morning.
Good morning.
Is that the direction of travel? Is that where things are heading?
I think so. The core PCE print that we got this week sends a very clear message that inflation is actually firmer than what we had expected. June feels more like an anomalous print. If you look at the data in aggregate for this year, you have to be thinking about some sort of policy action as soon as possible if you think that inflation is a concern. And that's kind of what I'd be here listening to hear from Chair Walsh, is that his characterization of inflation risks and how willing he is to act. He doesn't have to really give us forward guidance. He just has to characterize the data that we've gotten thus far this year. And that, to us, sends a clear signal that you need to kind of take some sort of policy action sooner rather than later.
They missed the target for 5 years. What's new? What changed? Why the loss of patience now?
Well, I think part of the reason why they've lost, they've kind of fallen behind is because, they cut quite aggressively last year. And then you had a whole bunch of other events that happened this year, which we thought could be transitory. The war in Iran, the tariffs, but all of that is changing. You're starting to see tariffs come back in the fore. The Iran war is not anywhere near its conclusion. And if you look at the broader, inflation complex, both goods inflation as well as services inflation is high and sticky. So, and then you look at the components of core PCE, things like healthcare, super core PCE is trending higher. You're looking at super core PCE at 3.7% or 3.8%. So that's closer to the 4% level than the 2% target. So if you look at the inflation picture in aggregate, it feels like it is sort of a call to action.
Is it a call to action you expect this chair to address? Do you expect not only for him to lay out any sort of framework, but also to sort of show his bias and whether he's leaning in a hawkish direction or to continue to keep rates where they are?
And that's the most important question, right? He's really not shown us what his thoughts are on inflation. But if you look at the committee in aggregate, if you listen to all the Fed speakers, I would argue that the committee has held a hawkish bias. And even his speeches, the takeaway for the markets has been that he's been somewhat hawkish because he's insisted that he cares about inflation. He has insisted that he cares about, defending the 2% inflation target. If that's the case, then there has to be some sort of a reaction or an action from the Fed to combat inflation.
What about a reaction to markets, specifically 30-year yields, which he said was doing work for him in terms of bringing in some of the conditions for this market now being tampered with, fooled with, whatever you want to say, by this Treasury? Do you think that that's an issue he needs to address?
Well, ultimately, I think the best way to address long-end yields is for them to raise rates, because the longer they keep policy on hold, the market's going to continue to push back on Fed inaction, right? You're starting to see a 5-year forward, 5-year break-even start to rise. Inflation expectations, that is, are starting to rise. And the market's going to continue to push back on Fed expectations. And this is happening at a time when, the market's kind of pricing in hikes for the Bank of Japan. And you're also looking at policy actions from other central banks, and the Fed is falling back. And the rise in bond yields is more of a global move. It's not just the U.S. So when global bond yields are moving, there's not much that one central bank can do to address it. It needs to be that the Fed can't really fall behind what other central banks are about to do.
I was reading some of the research from SocGen recently on this, that global yields are getting back to pre-GFC levels. Can you walk us through the difference between being on the edge of something sinister and going back to normal?
This feels like a recalibration. And if anything, if you look at the broader trajectory of debt and deficits, yields are not as high as you would expect them to be, given the trajectory for debt and deficits. So the market's giving policymakers in general a lot of leeway, whether it be the Treasury or the Fed, right? If there's true bond vigilantism, you would see a much more significant rise in global bond yields. In fact, you're seeing that more, I would say, in other countries, whether it be bond yields rising or JGB yields rising. You're seeing that treasuries, generally speaking, are outperforming our global counterparts. So given that sort of context, it feels like there's a lot of catching up to do.
Do you think you'd get interested in buying the long end anytime soon?
No, I think that I'm a little bit more nervous than I would have otherwise been. I mean, our call was that we were expecting the Fed to be a little bit more proactive. We were expecting global bond yields to decline in the back end because of Fed action. But now I think I'm getting a little bit more nervous, and a lot of the actions that the Treasury has taken, for instance, by surprising the market, leaves me a little bit more nervous.
You think that's made it worse for you?
In some respects, because if the market starts, pushing back in a meaningful way, then you're left addressing some of the harder questions, which is the trajectory for debt and deficits. Are they going to increase, taxes? Because there's only this much they can do verbally to intervene in the markets.
Do you think they're starting to put attention on things where there wasn't that much attention to begin with? And that's a factor in this too.
No, I think that the attention was warranted, but I'm not sure that the approach is really the right way, because buybacks are one way of kind of addressing the lack of liquidity in the long end, but it's not really a tool intended to cap bond yields. So I've heard investors talk about this as yield curve control or Operation Twist. It's none of that, right? Because it's all of those Fed actions causes an increase in excess reserves in the system, and that's a very different kind of mechanism for the markets. And if they do all of that, and if those policy actions come from the Fed, then that could be, again, a big concern for the inflation side of the picture.
Subadra, always good to see you. Thanks for being here. Subadra Rajappa there of SocGen. The nervousness of the long end. Heard something similar from Earl Davis of BMO earlier on this week. Earl Davis of BMO suggested there's more chance of getting 30s, or at least you'd see 30s get to 6 before you'd see 10s get to 5. And 10s are much closer to 5 than 30s are to 6, so that's quite a call on the long end of the curve.
It's a huge call, especially since there was maybe some hopefulness that the long end was coming in after the actions of this Treasury, or because the oil market. You can kind of take your pick on why that is. But yeah, that would certainly be troubling to this Treasury, and maybe it means that $4 billion is far from being enough.
Dealing with counterfactuals is really difficult, but let's say the Secretary didn't announce what he announced last week, and let's say he didn't work with the Japanese to stop them from monetizing dollar assets. I wonder where the bond market would be without those two things.
I think it's such a good point, this idea. Does that incentivize people to go into this bond market? Does it draw their attention to 30 years in a way that they wouldn't already? This is a market that likes to test the Fed chair. Will they like to test the Treasury Secretary, too?
To some extent, Danny, I believe the same thing about the Fed chair, too. We've missed the target for so long. A guy comes in and says inflation is a choice. I'm like, OK, here we go. He's going to do something about it. And then he doesn't. He's sort of set the bar for himself. That's where the disappointment has come from.
I think that's right, but I also think that this is a Fed chair who maybe wants to show that he can stand firm and not take on that test. I got a viewer comment writing in basically saying, I love how Wall Street thinks that they can tell Warsh what to do. I think the Fed is the patient adult, and Wall Street at times can be childish.
We'll see what we get.
Maybe he wants to be the adult in the room.
We'll see what we get in a few hours' time, 10 a.m. Eastern Time. Let's get you an update on stories worldwide this morning. Bloomberg's Brief with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Anthropic winning a legal battle against the Pentagon. A California judge ruling that the Trump administration unlawfully retaliated against the Claude maker by deeming it a supply chain risk. Anthropic still faces a separate legal fight in Washington Appeals Court. PayPal tumbling in the pre-market after sources telling us here at Bloomberg Advent and Stripe are abandoning their pursuit of PayPal. This after previously offering $50 billion for the company. Representatives for Advent, PayPal and Stripe all declined to comment. Oil exports recovering in the Persian Gulf. According to Goldman Sachs now, flows are up to 2/3 of pre-war levels as shippers and crude producers adapt with dark crossings and ship-to-ship transfers. The estimate from Goldman only includes the Strait of Hormuz and not Saudi exports through the Red Sea. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you very much. More from Vonnie in about 30 minutes' time. Up next, the morning calls. Plus, Munster of Deepwater Asset Management with one more read on tech before all eyes turn to Jackson Hole.
The market has this angst around the reaction function, around Fed credibility. I'm hoping we get, I think, to me, July was not a policy error, it was a communication error. So what I'm really hoping is a sense from Chair Warsh, why did they stay on hold in July?
Really, really well framed from Priya Misra of JPMorgan Asset Management a little bit earlier on this morning. If you're just joining us, good morning. Your price action looks like this in the equity market. Equity futures on the S&P just turning positive moments ago on the S&P 500, up by close to 1/10%. Still down by 0.2 on the Nasdaq. A massive move in the last 24 hours on shares of Nvidia. We'll get to that story in just a moment. 2s, 10s and 30s in the bond market. Stabilising around 420 at the front end, let's call it 423. Yields a little bit higher at the long end, up a basis point to 520 on 30s. That's the price action. Let's get you some morning calls. First up, Barclays raising its price target on HP, citing better than expected third quarter results. Your second call from Bank of America, raising its price target on Gap, saying second quarter momentum was encouraging. That stock is flying. And your third and final call comes from Morgan Stanley, raising its price target on Marvell, noting a positive messaging shift and opportunity for long-term growth. Let's stick with tech. Nvidia adding $442 billion in market value just yesterday, marking the second largest one-day gain by any stock in history. Jean Munster of Deepwater Asset Management joins us now for more. Jean, welcome to the program. For years, we used to talk about Apple, and Apple getting bigger and bigger, and people used to talk about deceleration. And it just felt like in the last few months we were doing the same thing with Nvidia. What was your reaction to that outlook from that company?
Well, I appreciate the Apple analogy, John. Actually, it's something that I've been thinking about more recently, that growth that Apple had. And just to put into perspective, what's happened with Nvidia over the past few years and looking towards next year, calendar 22, Nvidia did $27 billion in revenue. Calendar 27, so 5 years later, they'll likely do more than $700 billion. It's probably going to be $750 in revenue. So 27 to 750. The reason why I say that, and in the comp relative to Apple, is that what's happened with Nvidia has been breathtaking, even relative to the iconic tech moves that we've seen. And so the key takeaway here is less about what we've seen from 22 to 26. It's more about what we're going to see from 27 to 30, to get to your point here. It's been well documented here about the numbers, the guidance, the plus 70% revenue growth rate versus the street at plus 45%. That's for calendar 27. That was kind of the eye-opener from a couple nights ago. I expect that next year, calendar 27, will probably grow at 90%. That means that the growth rate in calendar 27 will be about the same as it is in calendar 26, 90%. And I think at the core of what's going on here, if we just look at the business, forget about the big picture with AI, but just if we look at NVIDIA's business, at the core of what's going on is that the customers simply just can't get enough capacity to do inference. And that is what is driving these numbers up. And ultimately, I still believe we're probably in the third inning of this build-out. Sounds hard to kind of wrap my head around that.
Almost
but
impossible.
I still think we're very early.
Jean, I really struggle with that, but that's the way things are heading. Jean, when you look at this company, one unique part of the way they operate is they look to foster and create their own demand by helping to build out the AI ecosystem elsewhere. What would you point to as a unique feature of that?
Well, I think from the demand side, it's just the speed of their chips that ultimately is what is driving all this. And that's what's allowing them to have this incredible pricing leverage. Kind of next year, probably 20, 30% potential pricing increase on some of their products. And I think that's the piece, John, that gets missed in this conversation, is that ultimately consumers or their customers really need these chips more than any other custom silicon. And so I think that's a big key takeaway here, is that they basically have the best stuff in town.
What then do you make of some of the other moves they've been making recently, Jean? Maybe lost in the news flow of that huge gain in earnings they had yesterday was the fact that they bought Hugging Face, a big platform for open source modeling and discussion. They have their own open source that they're working on too. Jean, what exactly is NVIDIA doing there?
So this is an important dynamic in terms of how NVIDIA sees the progression of models. And so what Hugging Face is for those who are more technical, it's effectively the GitHub of AI development. For those less technical, it's a library of open source AI models that people who are developing AI can basically pull thousands, hundreds of thousands of models and plug and play them into the development. And so that's what this is. The big picture here, Danny, is this is the theme around open source. And this is something that Jensen's been very supportive of. But there's a story underneath the surface that I think is more important to what the headlines are, which is Hugging Face is progressing NVIDIA into the open source world. What's most important here is that NVIDIA is basically building out, is doing the inverse of what their customers are doing to them. So just stick with me for a second here. If you look at customers like Meta and Google, they are building their own custom silicon. Effectively, they want to compete or they want to have alternatives to NVIDIA. What NVIDIA is doing here with Hugging Face, what they did last week with Poolside, a small acquisition, is essentially they're building their own models. In the event that their customers, their current key customers, start to do more of their custom silicon, they have an advantage to focus more on the models themselves and make money from the models themselves. It's just a fascinating dynamic. As tightly as these companies, the mega caps and NVIDIA hold their hands, NVIDIA is also getting some diversification in case those customers start to do their own custom silicon.
Well, there was also in the earnings outlaid some other hedging, just looking to other customers besides the hyperscalers, looking to sovereign AI as well as to enterprise. Jean, does that seem like a growing, at least the pace of growth fast enough versus their historical customers to kind of alleviate some of the concerns over concentration risk?
So the customer concentration, actually the top two declined in terms of total percentage of revenue, went from 38% in the April quarter to around 30%. And the reason is SpaceX basically came out of nowhere. It was a couple percentage of total revenue in the April quarter. It was probably about 5% in the July quarter. So they are getting some diversification within that. But to your point is the script is flipping in terms of where they're getting their growth from. If we're looking at for next year, those hyperscalers are expected to grow revenue just over 50%. If you look at the non-hyperscalers, the sovereign, like you mentioned, they're expected to grow around 85%. So why that's important is that what investors struggle with here, when we started and talked about this breathtaking increase in numbers, it's less about the law of large numbers. Google is a similar sized business. The issue is the slope of the deceleration of revenue. And as the non-hyperscalers grow, that gets investors more comfortable that decline from 90% next year to maybe 50% in calendar 28 won't be as sharp. And so I think that this customer diversification, this script flipping in terms of focus more on non-hyperscalers is an important piece that allows investors to sleep just a little bit better at night, knowing that growth curve isn't going to be as sharply declining as maybe some think today.
Gene, it's good to see you, buddy. It's been too long. Gene Munster there of Deepwater Asset Management. Real tech pro. See that audio quality?
Yes.
Right? Seriously. I'd expect nothing less.
You don't want someone talking tech and then their signal breaks up. It's disappointing.
Up next on the programme, we'll catch up with Mark Cabana of Bank of America ahead of the Fed chair's first speech from Jackson Hole. Plus, Yahira taking a look at software. Take a look at software. IGV yesterday, very well followed. ETF following software, having a day, up almost 8% on the session. We are heading towards a week of gains on the S&P 500. That can change in 90 minutes' time when you hear from the Fed chair. Equity futures right now turning positive in the last 30 minutes or so, up 0.1% on the Nasdaq 100. Down 0.1. In the bond market, 2s, 10s, 30s, yields settling down and stabilising around 420 at the front end, just short of 424 at the moment. Yields slightly higher at the longer end of things. 468 on 10s, on 30s, 520. As we count you down to the cash open, 60 minutes away. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Software has been a big part of the earnings story this week, and things were looking pretty good after Salesforce's results gave the group a big boost yesterday. You mentioned the IGV software index up nearly 8%, but what we're learning is that it is not a clean sweep for software, and that is being underscored this morning with shares of Elastic soaring 22%. That is a top gainer in the pre-market after raising its outlook, while Autodesk shares are down more than 4% after posting a weaker than expected earnings forecast. Moving on to Gap shares, those are rising now nearly 18% in the pre-market. The results themselves, they were pretty mixed. The company raised its outlook for adjusted earnings but trimmed its sales forecast forecast because of Old Navy, which has been struggling. And that is why investors are excited, because they're replacing Old Navy's CEO with a retail veteran from Target and Walmart. So they are hoping he can turn things around at Old Navy. And we are also seeing Affirm shares. They are rising 13% after strong results from the buy now, pay later firm. And there's also an interesting consumer read here. Spending through Affirm jumped 36% to more than $14 billion. So you can see consumers are increasingly using these buy now, pay later firms to fund their purchases. But importantly, Affirm says that credit performance remains stable. So maybe a stretched consumer that needs to use these services in order to make purchases. John.
Yahira, thank you very much. Thanks for the update and thanks for this morning. You might have heard there's a speech later on this morning. Investors counting down to hearing from the Fed chair. That speech taking place at 10 a.m. Eastern time. Bloomberg's Michael McKee joins us now from Jackson Hole with more. Mike, we caught up with Bramo about 30 minutes ago, anticipating this one. You've got some unique insight. You've covered these over the last several decades. What's unique about this moment for this Fed chair?
Well, it's always interesting to have the first speech by a Fed chair here because the speech gets so much attention. It's Kevin Warsh's first chance to be the person that everybody looks to. He's obviously been here before when he was a governor of the Federal Reserve, but now he's the man. And so everybody's looking for some sort of guidance on where the Fed is going. And obviously Wall Street has questions about where he thinks things are going right now. So there'll be a lot of focus on it. I thought earlier in the year this would be a rather dry and sort of inconclusive speech about the topic here of financial innovation. But the recent things that have happened in the markets and in the world may call on him to do more than that.
Mike, you mentioned to me privately just over email, I'm sure people don't mind me sharing it, there is an important data point coming out a little bit later this morning, but no one's going to talk about it. It'll get lost.
Yeah, at 10 o'clock this morning, the Bureau of Labor Statistics is releasing the annual benchmark revision to the payrolls reports. This would be from March of 2025 to March of 2026. And last year, if you remember, we lost 911,000 jobs, and it was a huge, major story. And this year they're projecting, or at least economists are projecting, we'll gain about 136,000, but we don't know. And those numbers will get folded into the prior Labor Department reports, and we'll get an active month-by-month breakdown come the first of the year. But it could be a big storyline next week as we head into the jobs report, the labor market either being stronger or, as in last year, significantly weaker than people had thought.
Mike McKee, thank you, sir. Get to set. Looking forward to the programme in 90 minutes or so. In fact, 30 minutes. That programme will begin with Mike McKee, Lisa Abramowicz and TK. Starting at 9 a.m, the speech starts at 10 a.m. On the data, it's been so noisy, so heavily revised. I think that does support the idea you reduce policy meetings and you come down to 6 every 2 months, which reportedly is what the Fed chair is proposing.
You could have even made that argument in July, given the data that we've seen so far this month. Was July just an anomaly, given the inflation figures that we've had? Again, wouldn't it be nice if Kevin Warsh tells us if that's the way things are heading?
We'll see. Mark Cabana of Bank of America has been one of my favourites in the last few weeks. Says this: if Warsh does not provide a plan and reaction function to bring inflation back down, we see risks. This accelerates the long end rate rise and levels could test 550 or higher. Mark joins us now for more. Mark, good morning.
Morning.
How high is the bar for this guy in 90 minutes' time?
It's not that high. Honestly, we think there's really two outcomes here. He sounds the same or he sounds different. We think he sounds different, and that's shockingly out of consensus. I think the market is generally anticipating that we get nothing, that he continues to provide no guidance, no framework whatsoever. Now, we expect to hear something different, and we expect to hear something different primarily based upon what the bond has been doing and what his counterpart at the U.S. Treasury has done. To us, that was a big tell. Clearly, the U.S. Treasury Secretary has been spooked by the moves at the long end. And we can debate what they are, what is driving them. Again, we think it's mostly uncertainty related to Warsh and the lack of forward guidance or the lack of a reaction function. Some may say it's IG supply. I doubt it's better growth, but who knows? You can make that argument as well. But clearly the Treasury Secretary got spooked and wanted to intervene in order to try and stop that long end rate rise. We expect that his counterpart at the Fed, Chair Warsh, will be supportive of that initiative, will sound different, and will give us some of that reaction function. Specifically, here's what we're looking for. We're looking to hear, how does being on hold, how does doing nothing achieve inflation back down to 2%? Now, there's an argument for that, but it would be really nice to hear exactly how that argument is working in Kevin Warsh's mind. We also, and I think most importantly for the bond market, need to hear what happens if things don't go according to plan. If there's a deviation, if inflation does not move back down to 2%, what do you do? And you don't have to tell us we're hiking in September or hiking in October or hiking in December. We know he cannot provide that guidance. There's still a lot of data to come. But what do you do, and how patient or impatient are you? Specifically, we're going to raise the federal funds rate. That's our primary tool. He did raise uncertainty and ambiguity around this in his press conference. And we're focused right now on core PCE at 2.0. Be specific about that. Reduce some of that uncertainty. Again, we judge that the long end has been plagued by a wider distribution of rate outcomes due to uncertainty that is created about the reaction function and what we're targeting. Are we using the balance sheet to bring down inflation or not? No. So we do expect him to sound different, narrow that range of outcomes. And look, the pushback that we get is that, well, Mark, what you're describing sounds a lot like forward guidance. And I know that. Now, my counter to that, though, is twofold. Number one, and I'm going to use a quote here from a sage and poet named Mike Tyson, who you've probably heard of, who said, everyone has a plan until they get punched in the mouth. And we believe that the bond market has been throwing haymakers. And we believe that they have landed at the Treasury Department, and that has prompted Bessent to act. Now, the question is, does Warsh feel similarly? Does he shift? I know he doesn't want to provide anything that sounds like forward guidance, but in this market moment, and given how the long end has responded, we do think it's quite important that the tone changes a little bit, that the guidance changes a little bit. Also, our second pushback on this is that, again, his counterpart has acted. And does Warsh want to be supportive of the Treasury Secretary or not? To me, the Fed and Treasury are like Army-Navy. Same team. They have generally same objectives. They have different reporting structures, and the Fed is supposedly much more independent than the Treasury. But are they moving in the same direction or not? If Warsh sounds the same, does not change his tone, then we expect that the long end will work to offset what Bessent has achieved so far. If he changes, we think it'll be much more supportive of that. We expect him to sound different. And if that's right, here's what markets do. So the market goes from pricing 9 bips in September to 12.5, 50-50 that they go. Not a guarantee that it happens. No, he's not going to tell us that, but you price in more probability of that. You'll see a likely bear flattening or twist flattening of the curve. So the market will price in some more hikes in the near term. It's going to sound hawkish, sort of tell us the reaction function, reiterate the impatience, and that we think will help push bond yields down. So we'll go from 5.20 to 5.10 and maybe back down to 5%. If he doesn't change tone, if he sounds the same, that's the quote that you've highlighted before. The bond very easily can go back to 5.50. And Bessent seems to have done his best to have drawn a line in the sand at 5.30. That's where he cares. If Warsh doesn't change, then the long end will continue to rise, and then Bessent has a lot more heavy lifting to do if he wants to try and bring down the long
Mark,
end.
All of that, again, the way the market reacts hinges on this idea, to your point, that the way it has moved is because of concerns about credibility. Can you just get into that more? Why do you not buy the arguments that it's about IG issuance and that it's about global growth, and that's why 30-year yields have been elevated?
So we talked about this the last time I was on, Danny, and I'll give you the short version. So if it's growth, then I would expect to see more positive economic data surprises. I would expect to see the Bloomberg consensus, where your contributors provide their expectations, to be rising. You see neither one of those things. Also, you've seen a steepening in the 10s, 30s real curve. And I struggle to believe that the market is adjusting its growth expectations for 10-year forward, 20-year growth when the data has been at best sideways, if not a little soft. So I don't really buy the growth argument. at least over the last couple of months. On the supply side, we've really learned nothing new on the U.S. fiscal front over the last 2 months. It's not a good story. It hasn't been for a long time. We all know that. Now, on the IG supply, there's been a lot of it. But I ask myself, how has this supply deviated from expectations? Have we really learned that IG supply is going to be a lot higher? That's not the sense I get from our IG strategists. It's also not consistent with price action that we see in the IG space. Since the bond really started to move over about the last 2 months, IG OAS is only wider by about 5 or 6 basis points. So it's off the tights, but it hasn't really repriced in a meaningful way. And if there was to be a really big shift in supply expectations, I would think that you see more repricing in the broader IG index. We haven't seen that. Is the IG story contributing to the move? Yes, it's a part of it. I personally believe, and our research has suggested, that it is not the primary factor. We think that the primary factor is just a much wider range of outcomes, broader uncertainty about where this Fed is going and how this economy will be evolving that is driving the long end. We expect that if we get a different sounding Warsh and a little bit more clarity from him today, that range of outcomes narrows, the bond rallies, and it does sound a little bit more hawkish. And then we'll see how the incoming data evolves as to decide whether or not they're going to hike in September or remain on hold.
So if this is a different Warsh and one that's working more in concert with the Treasury, does that mean he needs to change his tone on the balance sheet? Can he achieve this aim of a balance sheet unwind while also aiding a Treasury Secretary who's concerned about long-term rates?
We think that we expect him to provide more specificity on the balance sheet that will acknowledge that it's really difficult to reduce the size, but it's very easy to reduce the duration risk that they are holding. And we expect the argument on the balance sheet to shift more from size to duration risk. And on size, it's tough because, as you know, the Fed has 3 big liabilities. You got currency, that's very difficult to change. You got Treasury cash balance, that's unlikely coming down much. And you have reserves, and it's really a function of commercial bank liquidity preferences that drive reserves. They're going to try and adjust liquidity rules to reduce some of the reserve demand. We expect that to have a marginal but relatively small impact. It's hard to influence size, and if the Treasury Secretary is indeed buying back heavily at the long end or cutting the 20-year, they're going to likely need to use more bill supply eventually to do that. The Fed's doing reserve management purchases, they're buying bills, they're trying to anchor money market rates. That very much can shoehorn the Fed into growing their balance sheet more than they otherwise would have. So we just don't think that the argument on size is very compelling. Argument on composition, they're already making these adjustments. We expect Warsh to accelerate this process. I'm a little surprised we haven't heard it yet. And we think that what he will say is that, look, we can't reduce the size very much for the aforementioned reasons. We have reduced the duration risk that we are holding. That, all else equal, should be tightening financial conditions, adding more duration risk back into the private market. I've reduced the Fed's balance sheet footprint because we're holding less duration risk. I think he can make a very clean argument along those lines. And I expect that we're going to hear more of that, really, because that's the only thing that he can do. Now, the challenge with all of that is that when the Fed adjusts their portfolio composition, the onus then really shifts to the U.S. Treasury Department. Do they offset that impact? And mechanically, and I won't go through the mechanics, but trust me, they work, is that when the Fed goes through this process, as we expect, it will actually lower the weighted average maturity of U.S. Treasury debt outstanding. And so then the question becomes for the Treasury Secretary, do you offset that? Do you increase long-end auction sizes to limit that impact? And I think the answer to that is a hard no. That won't happen. So Warsh will make these arguments about the balance sheet. He will act on composition. He will accelerate that process in all likelihood. But does it actually tighten financial conditions? Not unless Besson is extending the weighted average duration of their issuance. And if anything, he's going the opposite way right now.
Marcus, good to see you.
Likewise.
Thank you, buddy. Thanks for dropping by. Mark Cabana there of Bank of America. Really setting the stage for this speech a little bit later this morning, taking place in 1 hour and 15 minutes' time. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. The United States is in talks with Venezuelan leaders to take a large stake in the nation's oil fields. Sources telling us here at Bloomberg, negotiators from both countries are discussing the proposal. Venezuela also considering an exit from OPEC. The FTC is exploring a possible lawsuit against YouTube. Sources telling us here at Bloomberg the agency has been investigating whether the platform broke consumer protection laws by suspending some user accounts. It's still unclear which accounts are part of the investigation. Citadel Securities posting a record $7.3 billion in second quarter trading revenue. Sources telling us that's more than triple the level compared to a year earlier. The firm getting a boost from its push into high-touch equities. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for this morning. Up next, we'll catch up with Matt Orton of Raymond James, waiting on a signal from Fed Chair Kevin Warsh at Jackson Hole. That speech just around the corner.
Confident that I am going to learn more today about Kevin Warsh as a leader, as a Fed chair. I may not like what I learn.
If we just get a payment speech or have a great conference, guys, that's not a great sign.
It's not enough just to say we're going to be tough on inflation. You actually have to do something. As people say, words are cheap.
Yeah, if it's just a payment speech and it's have a nice conference, guys, I think we're going to see some reaction in this market. Right now, equity futures on the S&P 500 just about positive by 0.1%, negative 0.1 on the Nasdaq 100. In the bond market, 2s, 10s and 30s, yields just about unchanged this morning at the front end, higher at the long end by a basis point or two earlier this morning, now unchanged at around 520, 519.72 on 30s, 10s at 468. Matt Orton of Raymond James writing, Jackson Hole and a busy September macro calendar could all create some near-term volatility. Matt joins us now for more. Matt, good morning. Good to see you.
Good morning.
What do you expect to hear in about an hour's time?
So, John, I don't expect to hear that much. I think Warsh has been pretty consistent that he doesn't want to provide any forward guidance. The subject, as you mentioned, is financial innovation. So whether we hear about stablecoins, maybe not, but I think he's going to use this to reset just what the bigger picture is. Maybe he'll define some progress that's taking place with respect to these committees that he's formed. But I don't think we're going to get very much with respect to near-term monetary policy.
Does that introduce volatility?
It certainly can. I think the market and the actions of Bessent are certainly putting pressure on Warsh to perhaps say something a little bit different. But I think he's going to stand his ground and really just be consistent.
We just had Mark Cabana on saying that he views the moves in the 30-year yield directly related to credibility of Warsh. Is that where you would look to see volatility should the market be delivered that disappointment in a nothing speech?
I think you could see it at the back end of the curve. It's most likely you're going to see it there. But at the same time, I think perhaps it could lead to a little bit of steepening as well, because if he doesn't come out as being directly hawkish or more hawkish than he's been, perhaps it puts a little bit of, or allows the front end of the curve to come down a little bit, because there are, 30-40% pricing expectations for rate cuts coming just in the September meeting, which I think is overdone. And so I think you could perhaps see a little bit of steepening, which maybe benefit some of the financial companies, especially smaller cap regional banks that have taken a little bit of a break. But I think volatility in this overall market is a good buying opportunity, because the fundamentals, when you come back to it, regardless of what Warsh says, the fundamentals of the economy remain very, very solid. We've just coming out of an incredible earnings season. We heard from Nvidia. There's a lot of opportunities across this market. So I would encourage clients, and what I've been doing is leaning into that volatility. If we get it, use that to position your portfolios accordingly.
Just to be clear, volatility in the equity market, or would you be looking to buy in bonds as well?
I think if you see the 10-year start to push towards 5%, that's a great opportunity for clients to lock in income. We haven't had those sorts of yields since the GFC. And so that's a great time for those who need income to take advantage of that. And so use what the market gives you.
You want to take the 32? We're selling bonds this morning. I found very few people that want to buy a 30-year Treasury. Do you?
Not really. I mean, there's not that much liquidity at the back end of the curve. And if you're an income investor, there's no need for you to be there. Stay 5, 7, 10-year treasuries, and then look at corporate IG as well. What's happening in the hyperscaler space. Some of the pushback with respect to the AI build out, I think, is overdone. The balance sheets of these companies remain very, very strong. And so you're getting a really good yield for some of that debt right now.
Where are you seeing pushback right now? Because we've taken down a ton of supply and investment grade spreads have done nothing this month.
Yeah, I think for me, it's looking in the equity space. I think fixed income offers very select income opportunities, but the opportunities across the equity universe are really, really interesting. I would actually argue that the AI trade has a ton of bearish pushback to it. I like that as an investor because it's not all a positive narrative like you had back in June. And so when you look at the reaction to some of the memory names, the supply chain components that should have been very strongly bid after Nvidia's earnings, we didn't get that. And I think that presents a really interesting long-term opportunity for investors because you've had this, in some cases up to 50% pullbacks in these names that are still down 35, 40% from all-time highs. Use that to add in some overall secular growth exposure to portfolios. And you can complement that. There's parts of this market like biotechnology, small caps. The Russell 2000 is the best performing index in the U.S. by far. And I think that can continue given the economic backdrop and the fact that earnings are supporting all of those gains.
Why do you think names like memory were too ignored after Nvidia earnings? Why did 70% revenue growth for next year not send the all clear?
Yeah, to me, I'm still asking that question. But I think, Danny, at least right now, I think there's uncertainty with respect to tariffs, what the White House policy might be. So I think there's a little bit of fear on the part of investors to really lean into that until we know exactly what might happen between the U.S., China, and the fact that a lot of these components are actually imported. So maybe when we get a little bit more clarity there, or when you start to hear Micron, SanDisk, Credo, some of those names report earnings over the next couple of weeks, that might clear those barriers. And maybe you'll see some good binary event, hopefully gains for those names.
Matt, it's good to see you. Thanks for being here.
Thank you.
Matt Orton there of Raymond James, heading into that speech from Fed Chair Kevin Warsh in Jackson Hole, Wyoming. Danny, thank you to you as well. Thanks for the last couple of days. Appreciate it. We're going to catch up Monday, Tuesday. Going to do the same thing.
I'll be here. Yeah.
Very cool. Brammer's going to take an extended weekend in Jackson Hole and do her thing. Good for her. Lisa's going to be busy through the next 2 hours alongside TK and Mike McKee, picking up coverage in just a moment at 9 a.m. Eastern Time, guiding you into this big speech from Fed Chair Kevin Warsh in Jackson Hole, Wyoming. The guest lineup looks like this. Beth Hammock, the Cleveland Fed president, alongside Esther George, the former Kansas City Fed president, together with Catherine Mann, the Bank of England MPC member, and the former Fed vice chair, Richard Clarida. That speech is about 1 hour away. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.